शुरू करें?
Yes.
Good afternoon, everyone. I, C. Anand Jain, welcomes you all to this today's virtual CP meeting on valuation of securities or financial assets. And to discuss on the same, we are having a very well-known and learned faculty on the same, CA Tarun Mahajan sir amongst us. I welcome you, sir.
Thank you.
We are also having an special invitee for this today's program, past chairperson of Indore branch, CA Sheetal Jain madam with us. I welcome you, ma'am. I also welcome all the past chairpersons of Indore branch and all the members who are watching this program. To begin with the program, I request Chairman of Indore branch, Harsh Firoda ji, to please give welcome remarks. Over to you, Harsh ji.
Thank you, Anand ji. Respected today's speaker, CA Tarun Mahajan ji. Past chairperson of Indore branch, CA Sheetal Jain madam. Past chairman of Indore branch, CA Pankaj Shah ji. Dear members, I welcome all of you on webinar on valuation of financial securities or assets. As you know, Indore branch is celebrating its 50th year of golden year celebration. For that, we are remembering our past activities, and for that, today we invited past chairperson of Indore branch, CA Sheetal Jain madam. CA Sheetal Jain madam was second female member, chairman of Indore branch after Kimisha Soni madam. और शीतल जैन मैडम के टेन्योर में नई ब्रांच बिल्डिंग्स में बहुत इंफ्रास्ट्रक्चर डेवलपमेंट काम हुए थे और बहुत सारी नई एक्टिविटीज, नए बैचेस बने थे. सो थैंक यू मैडम फॉर एक्सेप्टिंग आवर इनविटेशन एंड कमिंग इन टुडेज प्रोग्राम. मैडम, अबाउट द तरुण महाजन सर, आप सभी लोग भी से पढ़े हुए हैं, समझे हुए हैं और सभी लोग हम जानते हैं, बट फ्यू थिंग्स इफ यू डोंट नो व्हिच आई नो, ही इज अ वेरी गुड रनर एंड साइक्लिस्ट. इन्होंने साइकिलिंग, बड़ी लंबी लंबी साइकिलिंग चलाई हुई, इंदौर टू भोपाल, भोपाल टू इंदौर. अपार्ट फ्रॉम दैट, तरुण महाजन सर इज क्वालिफाइड वैल्यूअर और ही इज सेकंड पर्सन फ्रॉम इंदौर टू बी क्वालिफाइड एज अ वैल्यूअर. Regarding the branch next activity, on 17 there will be session on how to face corona, and for this chief guest will be Dr. Nishant Khare and Sanjay Lode ji. I request everyone to attend that program. It's again a CP program. Over to you, Anand ji.
Thank you, Harsh ji. As told by chairman that we are celebrating the 50th anniversary of Indore branch, and continuing the series, we are having amongst us past chairperson of Indore branch, CA Sheetal Jain madam, who has served Indore branch in 2012 as chairperson and 2010 as secretary. She has contributed to Indore branch in various manners. I would request you, ma'am, to please share your experience, share your memories of that time, so that other persons and other female chartered accountants, young budding chartered accountants can take benefit of that and can contribute to the branch in the future coming years. Over to you, madam.
Thank you, Anand. First of all, I congratulate all the members of Indore branch that we are in the 50th year, that is golden jubilee year of our branch. 1971. Indore branch, I think on 18th August, Indore branch came into existence. Well, I would just say Indore branch is just younger to me by a few months only. I share the birth year with Indore branch. So it is really my pleasure to speak something about Indore branch. I was involved in branch activities, I think starting from 2002-03. And now in the 50th year, we are all here to reminisce about the past. What I did as branch chairperson or what. गोल्डन जुबली ये होता है कि जब हम 50th ईयर पे पहुंचे तो सोचते हैं कि क्या हुआ था, कैसे हुआ, कितना हमने किया. जैसे आनंद ने कहा कि हमारी ब्रांच में, हमारे टेनर में क्या हुआ था. 2010 to 2013 वो एक गोल्डन पीरियड था. उस पीरियड में मैक्सिमम अवार्ड्स, एटलीस्ट 11 अवार्ड्स वर रिसीव्ड बाय इंदौर ब्रांच फ्रॉम ICI एंड रीजनल काउंसिल. It is a record till now. I will wish that this record is broken soon by the forthcoming persons. इंदौर ब्रांच में कोई भी टीम जो आती है तो एक टीम वर्क होता है जो टीम से ही पूरा मरता है. इट इज अबाउट द कंपेटिबिलिटी ऑफ द टीम. हमारी टीम थी, एक अच्छी टीम थी उस 3 साल में. आई वुड, बिफोर आई से समथिंग, आई वुड फर्स्ट ऑफ ऑल thank my secretary CA Sunil Maheshwari. He was with me throughout the year, and that is why we could achieve many things in that year. Others, CA Narendra Bhandari ji, and also immediate past chairman of the CA Vikas Jain and CA Vijesh Khandelwal ji. हमारी टीम में अदर मेंबर्स थे, सुनील जी खंडेलवाल जी थे, सुनील पी खंडेलवाल जी थे, मनोज गुप्ता जी, एंड मेंटर्स फ्रॉम सेंट्रल काउंसिल मनोज फडनीस जी and regional council Kemisha Soni. What we did in the हमारे रेगुलर CP प्रोग्राम्स तो काफी करे थे हमने, पर हमने एक मोटो के साथ चलते कि वी हैव टू बी विथ सोशल रिस्पॉन्सिबिलिटी पे हमने बहुत ध्यान दिया था. हमने एक बहुत मेगा इवेंट किया था, कैंसर अवेयरनेस प्रोग्राम, जो हमारे प्रोफेशन से तो हट के था, लेकिन अबाउट हमने उसमें वुमेन्स के लिए कैंसर अवेयरनेस प्रोग्राम फॉर ऑल ओवर इंदौर में एक प्रोग्राम हुआ था, उसमें हम पार्टिसिपेट किया था. एक उसके स्पॉन्सर्स थे, काफी हुआ था. इसके साथ ही जो हमने किया था कि बहुत एक सोशल जो वीक एरियाज हैं वहां पे हमने काफी लोगों को अपलिफ्टमेंट के लिए किया था. What I feel in the 50th year is that there is little participation of women till now. As Anand has told, I was the second, and after me only Gajan. In 50 years of branch, only 3 chairperson. It is a less one, but and I think Renali Biani madam has also come as secretary in the branch, but there is a less participation. I will request all the young girls to come forward and join the branch activities. I have seen many of you joining the editorial board, but I would like you to come in the MCM, and please come in a group. If you are alone, it makes lot of problems, but I will say please come 2, 3, and I will say the male members to please pave way for more female CAs. Let them come in group 2, 3 that they are coming. Even in CIRC, only Kemisha has served, and it is my utmost wish that in the Golden Jubilee year, we have a female president at the helm of the ICAI. Yeah. Next is in the branch activities. It is as I said, it is a team work. हमने बहुत लोगों को जोड़ा था. कई लोग जो जुड़ते हैं, जैसे हर्ष, आपकी टीम भी कई लोगों को भी जोड़ रही है, तो एक ये बहुत अच्छा रहता है कि वो जो जुड़ते हैं वो बहुत आगे तक जाते हैं. एंड आई कैन रिमेम्बर many of those who joined with us are now in committee, are chairman, and even have gone to regional councils. So it is really कि जो भी give them a chance. It is really very nice to give those persons a chance so that they are willing. गोल्डन जुबली सेलिब्रेशंस हम सब कुछ और ही सोचते हैं कि काफी सेलिब्रेट करेंगे, इट विल बी मेगा इवेंट्स, ये होगा, बट अनफॉर्चुनेटली दिस इज अ पेंडेमिक एरिया. कोविड पीरियड्स में काफी मुश्किल हुई, बट आई एम हैप्पी द ब्रांच कमेटी इज डूइंग एन एक्सीलेंट जॉब. आप लोग अभी भी इतने वेबिनार्स कर रहे हो, इतना नॉलेज अपडेशन कर रहे हो कि मतलब ऐसा लग नहीं रहा है कि ब्रांच एक्टिविटीज में कहीं कुछ कमी हो रही है, कुछ हो रहा है. आई विल डेफिनेटली अपलॉड यू ऑल चेयरमैन एंड हिज टीम फॉर दिस. नॉलेज अपडेशन में आपकी टीम का काफी अच्छा है. एंड हर्ष, आई वुड लाइक टू से कि आपकी टीम में जो कॉम्पेटिबिलिटी दिखती है, मुझे काफी याद आता है कि हमारी टीम हमारे समय में हमने काफी कॉम्पेटिबिलिटी थी, तो काफी उसको मैं कोरिलेट कर पाती हूँ। एंड सेकेंडली जब ये पोस्ट कोविड एरिया आएगा, टाइम पीरियड आएगा, आई डोंट थिंक इट विल बी द सेम एवरी, जैसा पहले था वैसे ही हो पाएगा। आपको इट विल बी मिक्सचर ऑफ ओल्ड एंड दिस न्यू। ये जो डिजिटल प्लेटफॉर्म है, वेबिनार्स का जो नया कंसेप्ट है, ये खत्म नहीं हो जाएगा। यू विल हैव द नेक्स्ट चेयरमैन एंड द नेक्स्ट कमिंग, उन लोग को देखना होगा कि इस प्रॉपर इसका ब्लेंड कैसे रहे। यू विल हैव टू गिव दिस नया प्लेटफॉर्म, नया काम रहेगा। पेंडेमिक में हमको न्यू अपॉर्चुनिटीज भी मिली है कि पहले काफी लोग बोलते थे इतनी दूर ब्रांच आ नहीं सकते, लेकिन हर्ष जी ने अब सबको घर बैठे वेबिनार में कर दिया, सब कर दिया। तो ये एक अच्छी है। आगे भी हम मिलना तो चाहेंगे ब्रांच में, पर ये इस तरह की चीजें कंटिन्यू रहे तो नेक्स्ट जो भी चेयरमैन होंगे नेक्स्ट, उनके लिए मैं यही कहूंगी कि वो करते रहें। एक चीज और मैं मैनेजिंग कमेटी से रिक्वेस्ट करना चाहूंगी कि कल फिर से स्टूडेंट्स के लिए, कल फिर से एग्जाम्स की पोस्टपोनमेंट की आ गई है। स्टूडेंट्स का थोड़ा सा मॉरल बूस्ट करने के लिए भी कुछ वेबिनार्स या प्रोग्राम्स करें। प्लस व्हेनेवर जब भी एग्जाम्स हो तो जो बाहर से स्टूडेंट्स आते हैं, अगर उनके लिए हम कुछ कोऑर्डिनेट कर सके कि कुछ रूम्स की फैसिलिटीज, सिर्फ कोऑर्डिनेशन चाहिए हमको कि हम उनको कर सकें, या कुछ ट्रांसपोर्ट की फैसिलिटीज कर सके, तो ये उनके लिए काफी अच्छा रहेगा। क्योंकि स्टूडेंट्स जो आज स्टूडेंट्स हैं, उनके अगर मन में हमेशा रहेगा कि ब्रांच ने हमारे लिए कुछ किया, तो वो आगे उनको एक बॉन्डिंग बनाता है सीए से, प्रोफेशन से, और इट इज वेरी नेसेसरी। अगर हो सके तो प्लीज लुक इनटू दैट। एंड once again I congratulate you, and for today's topic we have an excellent speaker, CA Tarun Mahajan sir. Valuation of securities or financial assets. This is the fast growing area in professional service. We all know traditional practice will definitely be take a back seat now, and we have to search for new areas. Valuation of securities. Valuation can be for business purpose, for regulatory, it can be for financial reporting, or for merger acquisition, many areas. But valuer will have to carry out professional services with giving relevance to the existing laws and standards. MCA has notified its rules, companies registered valuers and valuation rules. ICA has also issued its standards. So knowledge of this topic is essential, and not only for the professionals who are going for valuation services, but also in audit. It would be prudent to say that if we are doing an audit, we should know if of valuation, it is necessary to have some knowledge of these aspects. And I think with this, I will not take much of your time. And I thank you all once again for giving me an opportunity to address you all. Thank you.
Thank you, ma'am, for your great words. You have rightly said that the team which you have built in that time are now in the managing committee. I can memorize that in 2010 I have joined the branch as Sikasa team member as a student, and now I am into the committee. So thank you for that. आपकी जो ये इससे related articleship है वो उसी समय आप लोगों से ही मिली है. So thank you for that. Moving forward for the today's program, as we all are aware that asset valuation plays a very important role in the finance and often consists the both subjective and objective measurements. The value of companies' assets like fixed assets or capital assets are very easy to value. Very straightforward methods are there to value that, but no number has been given to the intellectual assets or the non-financial assets, securities. So today, to discuss on the same, we are having with us CA Tarun Mahajan sir, who is a chartered accountant by profession and also a CFA from USA. He was the first CFA chartered holder from Central India. He is also practicing as a registered valuer and doing valuation assignments across the India. He is also into the pool of the faculties of ICAI, ICSI, and as well as ICMAI, registered valuers organization, and has traveled across the India to taught more than 2,000 professionals in last 1.5 years. Besides, as Harshbhai has told, he is also a marathoner, cyclist, swimmer, and first from MPCG to ride bicycle of 600 kilometer. His knowledge on the topic valuation and finance from last 21 years is going to benefit all of us. Thank you, sir. With these words, I invite you for your presentation. Thank you, sir. वैसे आपकी क्लास समय से ही शुरू होती है हमेशा. So we are on time. Over to you, sir.
So first of all, good evening, everybody. And I would like to thank Indore branch of CIRC of ICAI to give me this opportunity to interact with all of you here on this platform. I was just talking to Anandji and I was discussing that this pandemic has given us an opportunity. You know, for all of you, the CPR quota has already been done and still around 200 members are participating over here. So that participation was not actually feasible when the programs were happening at the branch premises. You know, leaving your office and going there and attending the program was not feasible for you. But now the strength has gone up in some of the webinars. Even in Indore branch, the 500 members presence is there. So chartered accountants have proved that pandemic is an opportunity for them, and it's not something like that to keep them down. I must compliment the Indore branch team, the young team, energetic team, dedicated team. If you tell me to devote 2 hours daily at the branch, leaving my personal jobs, it's really very difficult. So you guys, a round of applause for all of you, that besides your professional and personal commitments, you are devoting your time and you have made many significant contribution to Indore and to all over India now on webinar mode for the profession. So I welcome you again to this virtual CPE meeting. You have given a nice name, VCM, virtual CPE meeting. So this is a meeting, guys, and it's not a seminar. In a seminar, there is a monologue. So there is one speaker who keeps on speaking, and there are other people who are actually simply listening. But as the team has given a name of meeting, so let's try to maintain a dialogue. I'm not the speaker over here. I am just, you can say, a moderator. And any one of you are most welcome to contribute over here. Just feel free to ask if you have any questions during the session or even after the session. You can use the chat window or you can raise hand and the admin people will unmute you and then you can speak out also. That will be really very nice. Many of my seniors are also here, I'm sure. And many taxation experts, many Ind-AS experts, many companies act expert, many GST experts, and many more experts are over here. I just know about valuation because I'm practicing it. So if there is anything which can connect valuation and the other streams, I will invite you to speak over here today only so that even I can gain some extra knowledge on valuation and I can also get benefited by this seminar, better I say meeting. I have divided this whole session into 2 parts. So one part is provisions of various acts where valuation is required. And second part is how to do the valuation. So first of all, I'll devote time on the provisions and whatever time is left thereafter, then we will devote that time on how to actually do the valuation. And in the second part, we will shift to the workshop style rather than the meeting style. So in fact, I will request all of you also to open the Excel sheet and do the calculation with me. One more thing I would like to say. On one hand, there are some expert people who have joined this meeting. So they already know each and every single thing. And on the other hand of the spectrum, there are some people who may not be having background of today's webinar. So I'll try to make justice to both ends. We'll start right from the scratch, right, very basic, simple things, and then we'll try to touch the advanced issues. I would like to share my screen. Just give me one moment. A moment, please. All right. Sorry. So first of all, there may be a question that valuation is to be done by a registered valuer. So what is there for me as a practicing chartered accountant here in today's webinar? What is my benefit? That is the first question. What's my benefit? What is there for me? So here is the answer. If you look at the Foreign Exchange Management Act, a registered valuer as of today cannot do the valuation under the Foreign Exchange Management Act. Only a practicing chartered accountant or CMA or merchant banker can do the valuation. If you go to a merchant banker for the purpose of valuation for your client, see what happens that getting a merchant banking license is a very difficult job. And that's why merchant banker will ask for a very high fees. And chartered accountants do that job at quite a reasonable fees. So there is a huge scope for practicing chartered accountants, even if they are not pursuing registered valuer course, to do valuation under FEMA. Number two, under Income Tax Act also, under some of the sections, under some of the rules, sub-rules, clauses, sub-clauses, a chartered accountant is qualified, is eligible to do valuation. A registered valuer cannot do valuation under Income Tax Act. Only a chartered accountant can do it, or a merchant banker. So that depends on which section or which rule we are actually referring. So yes, there is a scope for a practicing chartered accountant under FEMA as well as under Income Tax Act as far as valuation is concerned. Number three, advising the right course of action to a client under various acts. So this week only, I was doing one valuation assignment of compulsorily convertible preference share of a Delhi-based company. And when I asked for historical financial statement, I saw that the company has also issued optionally convertible debenture last year. So besides that, I asked management that the valuation must have been done for optionally convertible debentures also. So management, we were not aware about it, that even the OCD need to be valued and its valuation report need to be filed with the registrar of companies. Now that was a lapse because the client was not aware of the regular updates which are happening in the world. So you cannot expect even the client, a businessman, to have the all updates. Rather than it is your duty, sir, to guide him properly that under what provisions valuation will be required. So that's the scope as a practicing CA. Point number 4, questioning value of investment as an auditor, especially under Ind AS. Now, Ind AS is mostly fair value based. Even if you don't talk about Ind AS, and if you simply talk about AS, slowly and gradually, ICAI is aligning AS with Ind AS. So within a period of time, within not longer time, say 1 or 2 years, it will happen that AS provisions will be very much same as the Ind AS. So fair value accounting is the future. It is the present and it is the future. And it is the duty of a chartered accountant as an auditor to question the items of balance sheet, especially investment made by the company in the securities of other companies. So last week, I was doing one valuation of equity share of a Mumbai-based company because that company became associate of a listed company and hence covered under Ind AS. So I did the valuation, I submitted the report. And believe me, the auditor, who was one of the big 4, he literally grilled me for my valuation. They thrown at me a 17-pointer email to answer all those questions, that how did I exactly do the valuation, what was the method, why I choose that method and not any other method, how did I calculate cash flow, how did I arrive at the discounting rate, why have I have given discount for lack of marketability, how come the data of the Sensex, from where did I take the data of risk-free rate of return. A 17-pointer email was there. I answered all of their question. After that, we had a conference call, and they literally grilled for each and every aspect of the valuation. So it is the right as well as the duty of the auditor to check at least do the hygiene check of the valuation. So that's the scope for a practicing chartered accountant under valuation. And then we will be doing the second part of this webinar, that is how to do valuation, and we'll be doing it using a Microsoft Excel, and some fantastic things will be there. So maybe some of you will start loving this valuation as a profession, and you can aspire to be a registered valuer, and it's not really very difficult. You can also pursue it. So that is the actually scope of valuation. So we'll discuss it one by one. Valuation requirement under the Companies Act, under the Insolvency and Bankruptcy Code, under the Income Tax Act, under Foreign Exchange Management Act, and under Security and Exchange Board of India guidelines. So let's approach it one by one. First of all, let's discuss provisions of the Companies Act 2013, where valuation is mandatory, it is compulsory. So you need to guide your client about this, that if you're doing this activity, then you must get your shares valued, and that report will be submitted with the Registrar of Companies along with some forms, and that is the requirement. So total 1, 2, 3, 4, 5, 6, 7, 8 points I have given. Valuation of sweat equity share, allotment on preferential basis, buyback under section 67, not the regular buyback under section 68, non-cash transaction with directors section 192, compromises and arrangements, especially mergers and demergers under section 230 and 232, cross-border mergers under section 234, winding up of a company under section 281. So let's see, first of all, issue of sweat equity shares. This is given in section 54, subsection 1, clause D of the Companies Act 2013. Read with companies issue of share capital and debenture capital rules, rule number 8. So you can see that many software company and many consulting companies, where human resource is the most important resource, is the most important input for running a company, one of the challenges to retain the employee. And one of the ways to retain employee is to make share-based payment. It may be a win-win situation. There will not be outflow of cash for the company. And on the other hand, employee will feel like he is also one of the owners of the company, and he will work more dedicatedly. So whenever a company is going to make allotment of sweat equity shares, now here in this case, 2 valuation reports are actually required. Number one, as the company is issuing, obviously, I'm talking about unlisted companies. My whole discussion under the Companies Act is mostly based on unlisted companies, maybe a public company, maybe a private company, maybe a one-person company, whatever it is. Mostly a public or private unlisted company I'm talking about, because if a company is listed, then it need to follow the SEBI guidelines. So if unlisted company is going to make valuation, going to issue sweat equity shares, then 2 valuations will be required. Number one, as the company is giving its equity share, so valuation of equity share as a going concern on fair value basis will be required. And number 2, why are you giving sweat equity shares to your employee? Because he has given you some know-how, some intellectual property right, or any other value addition he has given. So how can you say that he has given you value addition or know-how or patent right worth rupees 1 crore, and that's why you are giving him shares worth rupees 1 crore. So you need to make valuation of that intellectual property right or value addition also. Two valuations will be involved over here. When I say value addition, it may be historical or it may be based on some future services. So one employee was working with the company for last 10 years or say last 5 years, and company saw a progress in sales and the profit of the company. He cracked some of the very difficult deals which were quite impossible, quite difficult to crack. And you can identify that this much amount of business of the company is due to this Mr. X. So identify that amount of sales, calculate profit on that amount of sales that is actually contributed by employee, deduct the salary which you have already paid to him, and then calculate future value of all those benefits to arrive at the fair value of the value addition which the employee has given. If the value addition was historical, definitely for company it will be expense. Value addition may be anticipated also. In that case, you will have to estimate future contributions to be made by employee, and accordingly, the valuation will be done. But let me tell you, under the Companies Act, currently only a registered valuer can do a valuation. Now, one more thing, if you advise your client to issue sweat equity share, be prepared for valuation at 2 points of time. Number one, when you are issuing sweat equity share, value of equity as well as value of IPR need to be calculated by registered valuer. Number two, as the sweat equity shares are immediately exercised, under Income Tax Act, a registered valuer is still not mentioned over there. So valuation by a merchant banker will also be required. So this is one situation. Now, number two, section 62, subsection 1, clause C of the Companies Act 2013, which talks about allotment on preferential basis. Okay, so I'm getting one. Am I properly audible?
Yes, sir. Yes, sir, you are audible. Yes.
Okay, great. Okay, so one of the feedback was like the volume is low. All right. So 62(1)(c) is like allotment on preferential basis, maybe for a cash consideration or maybe for a non-cash consideration. So this is one of the most important section where valuation is actually required. So let's see. Valuation, number one, valuation is compulsory if you're making allotment on preferential basis. What is preferential basis? That is really quite clear. If you are issuing shares to a person who is not existing member of the company, that is preferential allotment. If you are issuing shares to existing members in a proportion which is not the existing proportion, that is also the preferential allotment of shares of the company. In this case, valuation is compulsory and valuation must be done by a registered valuer. And suppose registered valuer says that value of one equity share of the company is rupees 500. So in that case, company can issue equity share either at rupees 500 or at a price more than rupees 500. Company is not allowed to issue shares below the fair value reported by the valuer. Company cannot say, okay, so the fair value is 500, but we want to issue shares at 400 rupees. That is not actually allowed. Number two, in case of non-cash consideration. So last year I was doing one valuation where the business of the proprietorship was actually acquired by the company. So proprietor himself was a director and shareholder in the company, but as a separate legal entity, company was buying business of the proprietorship and issuing shares to the proprietorship as a consideration. Again, here two valuations are required. It may be incorporated in a single report or two reports may be given. That really is your choice. But yes, two valuations are required. Number one, valuation of equity share of the company, which is buying business. And number two, valuation of the business which you are going to buy, maybe a proprietorship business, a partnership business, or any other format of organization may be there, but valuation of business will also be required. Number 3, valuation is not required in case of, So valuation is not required in case of right issue of shares. Right issue does not require any valuation, but if some of the members decline right issue, then as per section 62, the board of directors in the best interest of the company can decide how to issue these shares. Now, initially when the valuation became compulsory, some of the people, they tried to avoid the valuation, that this is one additional expense, this is one additional burden for the organization. So we should devise some method. They said that, okay, we asked members for the right issue, they declined it. So declined share are now in the hands of board of directors, and Companies Act does not have a very clear-cut guideline that what to do with that. So now valuation is not required because we have already tried to make the right offer, but they were not ready to take it. They don't have any objection. So at whatever price we sell, they should not have any other objection. So valuation, people tried to avoid the valuation, but that is absolutely wrong. Declined share, if it is issued by board of directors, then the valuation in that case is also must be done. In fact, there was one interesting situation. So one of the clients through one fellow member came to me and they were saying that, right, they were reluctant that, okay, why to do the valuation? When the valuation was done, the value of target company came lower than what they were going to deal. So the client said, how can you say the valuation is lower? We explained the client that how this valuation is lower, and even he was convinced, and he renegotiated the deal with the target company, and he bought the shares of the target company at a comparatively lower price. And I think 10 times the valuation fees he recovered by getting done the valuation. So that is the thing. Now, second point, what if any of the members after the right issue, they renounce their right in favor of some other person? So actually Companies Act doesn't say that in case of renunciation, you are making allotment of share to some new person, maybe who is not the existing member. So valuation should be done. No, nothing is written like that. But as a good governance practice, it is recommendatory. It is advised that valuation should be done. But I can't say with confidence that it is compulsory. So might be, let's say it's not actually compulsory. In fact, people go even a step beyond. They say, okay, how to avoid this valuation exercise? So first of all, let's allot shares, and then the member will sell these shares. Now, the interesting thing is there, under the Companies Act, if shares in unlisted company are transferred by one member to other member, in that situation, under Companies Act, valuation is not required. But under Income Tax Act, you will be covered under Section 50 CA. So you are planning on one hand, and maybe it can it can create a problem at other end. So try to avoid, teach your client to avoid that type of thing. Okay. Then I am coming to point number D. Valuation is required even if shares are issued to existing shareholders disproportionately. Yes. So there are 3 shareholders in a company, private company, Mr. A, Mr. B, Mr. C. They are holding shares in the proportion of like 40%, 40%, and 20%. Now company is going to make allotment of existing capital is 1 lakh shares are issued. Company is going to issue 50,000 more shares. And all these shares are to be allotted to Mr. A only, or 80% to Mr. A and 20% to Mr. B and 0% to Mr. C. Now, this cannot be classified as a right issue, because under the right issue, there must be an offer in the proportion of existing shareholding. Therefore, in this particular case also, valuation is actually required. So the only case where valuation is not required is a genuine right issue, and number two, transfer of share by one member to some other person. Now, just like sweat equity share, there is one more share-based payment to employees. Issue of employee stock options, ESOPs. Now, ESOPs are obviously different from sweat equity shares. In sweat equity share, you are not giving it for the free. You are taking a consideration in kind that you give me your knowledge, you give me your intellectual property right, and I'll give you share. And mostly it is based on the past performance of the employee. While on the other hand, ESOP is a trick to retain the employee for a longer period of time. I give my employee a stock option that after 3 years, you can buy shares in the company at a nominal price of, the face value is rupees 10, but I will give you the share for 50 rupees. That is the exercise price. Face value is rupees 10, but after 3 years, you can buy 1,000 shares in the company at 50 rupees, strike price. Even if the fair value at that time is 1,000 rupees or 200 rupees, you will have a right to buy at 50. If the fair value is below 50 rupees, you need not to exercise this right to buy. So the choice is with the employee, whether he would like to buy shares in the company or he would not like to buy shares in the company. ESOP, this is actually called. And again, the software company, consulting company, human resource based companies, they offer a lot of ESOPs to employees. And in the startup culture, it's a very popular way of remunerating to the employees. So again, in this case, valuation is required. Now, one valuation will be done by the registered valuer at the time of grant of ESOP. In case of ESOP, there is one grant date, there is one vesting date, and there is one exercise date. Grant date, when the company says you are entitled, we are giving you ESOP. Vesting date means if you complete this 3 years period, thereafter you can buy shares. So after 3 years, there will be vesting date. And after 3 years, you will have 1 year time period or 6 months time period to exercise this option. So that is the exercise period. On the grant date itself, valuation of equity share for the purpose of ESOP will be required to be done by the registered valuer. But after 3 years, when employees exercise this option, at that point of time, a valuation by merchant banker will be required for the purpose of Income Tax Act. If I'm not wrong, I'm not the tax expert. If I'm not wrong, so on the date of exercise, this fair value difference between the amount paid and fair value of the equity share is taxable as a salary income for the employee. So on that date, a valuation by merchant banker will be required. So in case of sweat equity share, as well as ESOP, under Companies Act, valuation will be done by registered valuer, and under Income Tax Act, valuation will be done by merchant banker. Merchant banker is not allowed under Companies Act. Registered valuer is not allowed under Income Tax Act. So obviously, it's a double burden of fees for the client. There are expectations that over a period of time, all these acts will be aligned. So even a single valuation will work for both the acts. Okay, so there is one question meanwhile from Padmini ji. Valuation not required for right issue under Companies Act, but needed under Income Tax Act. But Rule 11 UA mentioned merchant banker or accountant. So whether a CA can issue valuation certificate? Very nice question, ma'am. So this is actually I will address this issue today only. Under the Income Tax Act, how to do the valuation and who will actually do. So as far as the equity shares are concerned, under the book value method, a chartered accountant can do. It's not required, but usually CAs certify it. But book value method rarely holds good, beneficial. So mostly the valuation is done with DCF method. So under Income Tax Act, valuation will have to be done by the merchant banker. But I will cover it in detail. After this Companies Act provision, we will first discuss Income Tax Act provisions. And then we'll move to the SEBI and IBC. Okay. So now this F point. Valuation, so far what we discussed is valuation is required for unlisted companies. But even if the company is a listed company and making allotment on preferential basis, valuation of its equity share is required even for a listed company if its shares are infrequently traded. The condition over here is if its shares are infrequently traded. Now, what is frequently traded and what is infrequently traded? That's a question. So here infrequently traded means number of shares traded in last 12 calendar months are less than 10% of the total number of shares of that class. So suppose today on 14th of October, a listed company is planning to make allotment of equity shares on preferential basis. So last calendar month ended in September. From 1st October 2019 to 30th September 2020. That is 12 calendar months. Suppose the stock is listed only on Bombay Stock Exchange. And on Bombay Stock Exchange, when you make a total of trades, number of shares traded during the 12 months period, say company has issued 1 crore such equity shares, existing number of shares with the company are 1 crore. And in last 12 months, number of shares traded are 9 lakh. So 9 lakh shares traded, company has issued 1 crore number of shares. That is just 9% of the issued capital of that class. So it will be tagged as infrequently traded. And in this case, even if the company is listed, it is treated as unlisted company for the purpose of valuation, and valuation is to be done by the registered valuer. Now, there are two problems. Number one, what if a company is listed on more than one stock exchanges? And what if the number of shares changes during the period? So I would like to I give you one calculative example over here. Let's say situation is like this. Allotment is to be done on 14th of October 2020. So 12 calendar months means from 1st of October to September 2020. Yes, Vidyaji. Under income tax act, chartered accountants are not allowed, but chartered accountants are still allowed under some of the sub rules and clauses and sub clauses. I'll tell you about that. Under DCF method, only merchant banker can do it. But there are other ways where a chartered accountant can also do valuation. We'll discuss about it later. So let's first complete this Companies Act part, and then we will discuss in depth about the income tax part also. Okay, so existing number of shares of the company are say 1 crore. And shares traded during this period were 9 lakh. So now it will be tagged as infrequently traded. But on the other hand, if 10 lakh shares were traded, then this is frequently traded. If more than 10 lakh shares are traded in the last 12 calendar months, say 12 lakh shares were traded, in that case also it will be tagged as frequently traded, and the valuation will not be required because that will be covered by the ICDR of SEBI. This is one thing. Now let's discuss one more situation. Say on 1st of October, number of shares were 1 crore. Okay. But on 1st of April 2020, company issued 1 crore more shares. And we want to check 10% for a period from 1st October 2019 to 30th September 2020. So during the 12 calendar months, 1 crore share remained there for whole 1 year, and 1 crore shares which were issued on 1st of April 20, it remained there just for half number of year. So I'll have to calculate here the weighted average, and then I'll make a sum total. And in this case, I will say that number of shares, that number of shares in the company are not 2 crore. Existing number of shares are 2 crore, but weighted average number of shares are 1 crore 50 lakh. So if 15 lakh shares are traded, it is frequently traded. If less than 15 lakh number of shares were traded during last 12 calendar months, in that case, it is infrequently traded and a valuation report is required by a registered valuer. Now let's discuss one more issue over here. Suppose the company is listed on 2 stock exchanges, Bombay Stock Exchange as well as National Stock Exchange. So what should I do? Should I make a total of the 2 number of shares traded at 2 stock exchanges? No. You will have to take the stock exchange where in last 26 weeks, suppose the share is listed on BSE as well as NSE, and weighted average number of shares are 1.5 crores. At BSE in last 26 weeks, that is roughly half a year's period, number of shares traded were 4 lakh, and at NSE number of shares traded were 3,50,000. So we will ignore NSE in this case, and we will consider Bombay Stock Exchange as the stock exchange where the share is listed, and we will take number of shares which were traded at BSE only. We will not consider NSE in that case. So if I get back here, so if number of shares changes, then take weighted average number of share. Stock exchange means the stock exchange where highest trading volume in respect of the equity share of the issuer has been recorded during preceding 26 weeks prior to the relevant date. All right, so this is the F point. Now coming to the next. Okay, now let's talk about listed company. If a listed company is making allotment of shares on preferential basis, that is to selected few people, in that case also, the valuation is required, but you don't need a certificate from a registered valuer. You don't need a certificate. So in that case, how do you decide the issue price? In case of a listed company with frequently traded shares, issue price should be at least means minimum of average of weekly high and low of volume weighted average price of last 26 weeks, or average of weekly high and low of volume weighted average price of last 2 weeks. See, the company is listed, frequently traded, so registered valuer certificate is not required. But as a good governance practice, companies do take a certificate from a practicing chartered accountant and keep it in record so that tomorrow if anybody questions, it is there in the record. So that may be a little bit of scope here. How do you calculate the average of weekly high and low of volume weighted average price of last 26 weeks? So if you look at the prices quoted on any stock exchange, you will find open, high, low, close, and average price. So first of all, ignore the open, high, low, and close price and take the volume weighted average price, which is already given by the stock exchange. You need not to calculate volume weighted average price. Suppose I am talking about week number 1, and in week number 1, I'm talking about day number 1, 2, 3, 4, 5. And VWAP, volume weighted average price of the share, has been 200 and 190 and 180 and 230 and 210. This is the volume weighted average price. So first of all, this is for week 1. You take the highest of the one, that is 230 rupees, and lowest one, that is 180 rupees, and then you calculate average. So number one, it is already average for the day, and now you are calculating average for the week based on the high and low of the week. So how do you calculate the average? That's very simple. You take 180 plus 230 divided by 2. So this is for week number 1. So this is average for week number 1. Now similarly, you will calculate average for week number 2. And similarly, you will calculate average for week number 26. And say this is 220, say this is 150. Now you have to again take a simple average. You have to again take a simple average. So you apply the average formula over here. So, in this whole calculation, the average has been done 3 times. Number 1, the daily average, which is already done by the stock exchange. Number 2, the weekly average. And number 3, the average of the 26 weeks. This is average of the 26 weeks. Suppose average of the past 2 weeks. Let's change this to 290. Suppose average of the past 2 weeks is 300 rupees, or average of the past 2 weeks is 300. So now average of last 26 weeks was 283. Average price on the stock exchange of last 2 weeks is 300. And you have to choose higher of the two, which is actually 300. So company can make preferential allotment of equity shares at a price of rupees 300 or above that price. So as I said, this valuation is not required to be done by a registered valuer. So definitely, as a good governance practice, companies take certificate from practicing chartered accountants over here. Okay, now the next thing. Now, besides equity shares, valuation is required even if the company is making preferential allotment of convertible securities. Say the company is issuing compulsorily convertible preference shares, or it is issuing compulsorily convertible debentures, or it is issuing optionally convertible preference share, or it is issuing optionally convertible debentures. In these cases also, if a preferential allotment is made, valuation is required. And believe me, valuation of OCD and OCPS is a very complex exercise. The black and Scholes option pricing model and every single aspect of the valuation has to be used, then only you can make the valuation. And the real life challenge is that you don't get the proper data. Our stock market, our financial market is not as mature as that in the Europe or USA, where you can easily fetch market data. In India, the biggest challenge for a valuer is to get a good data so that he can make valuation. Now, you might be thinking that are these instruments actually popular? Let me tell you, all these startups nowadays, this OCPS, CCPS, OCD, and CCD. And this is all these things are there. So you must, these are, very popular among the startups. If you look at one of the valuation report of Zomato, see, look here, what Zomato has done. So I was referring to one of their valuation reports and see what they have issued. Class A triple CPS, cumulative compulsorily convertible preference share. Class B, Class C, Class D, Class E, Class F, Class G, Class H, and Class I. And then their seniority ranking and everything is given over here. So yes, these are very popular. So meanwhile, there is one question that while we are taking number of shares, should we take the delivery based number of share or total number of shares? As nothing has been specified in the SEBI guideline that you should take delivery based number of shares or total number of shares traded, definitely you can take total number of shares which have been traded. Then the next question will be, then in that case there may be manipulation. So yes, that's very much feasible. It can happen, but then also you cannot escape the grip of the regulator, because there also then you will be classified as frequently traded, and then you will have to check this 26 weeks things and 2 weeks and all these things. Then only you can make allotment of shares. Sorry. Now, in all these complex instruments which are very popular, because even for the investor it gives a very much flexibility, and for the startup also it gives flexibility. Equity shares are quite rigid. These instruments are very flexible. So last week I was doing valuation of one, not last week, better I say last month, I was doing valuation of one Bangalore based startup. And I have seen, once they gave me the assignment for valuation of CCPS and OCD, first of all, I took whole 2 days time period just to read their 80 pages shareholder agreement with the investor. Because the company was a private company, and section 43 of the Companies Act read with section 47 of the Companies Act says that 43 and 47 are not applicable to a private company, or better I say applicable subject to the article of association of the private company. And they changed article of association and they devised very creative new instrument, a CCPS, which has a right to vote even before conversion, and CCPS, which has a right to dividend in equal proportion to the equity shareholders if dividend is given at all. The fixed rate of dividend on CCPS was 0.0001%. But if dividend is given to equity shareholders, they will also be entitled to dividend in same proportion. Very creative instrument. And OCD, they said OCD holders also have the right to vote. Now, how is it possible? Section 71 of the Companies Act clearly denies that you cannot issue debentures with voting rights. But at the same time, 43 and 47 says that private company can do whatever it wishes to do as per its article of association. So first 2 days I took just to read the entire agreement. Then only I could decide the nature of the instrument. Then only I could do the valuation. There may be a question, why do they design such complex securities? So one reason is flexibility for management. Second reason is flexibility for investor. Third reason, maybe some tax planning. I'm really not aware what kind of tax planning can be done over there, because some of the foreign investments are also were involved in that particular case. And maybe under the Companies Act also, it becomes sometimes convenient. Now, when we talk about convertible securities, Companies Act gives you two choices. Either you get done the valuation of your equity share, because ultimately whether it is convertible preference share or convertible equity share, it will be converted convertible preference share or convertible debenture. Ultimately, it will be converted into equity share. So you need, first of all, you need to make valuation of equity share. And on that basis, valuation of these complex securities. When to do the valuation, when to submit the valuation report. So there are two things. They have given you choice, either at the time of allotment of these securities or at the time of conversion of these securities into equity shares. To my mind, if the conversion ratio is fixed in advance, that one CCPS will be converted into one equity share, one OCD may be converted into 10 equity shares. If the conversion ratio is pre-decided, then it is obviously the best practice to get done the valuation today itself when you are issuing these complex securities. But if there is variable ratio, so in many CCPS, company says that these preference shares are convertible on the basis of fair value of equity share on the date of conversion. So suppose 1,000 rupees is the fair value, is the face value of preference share. 1,000 rupees is the face value of preference share. And it is said that after 5 years, it will be converted into number of equity share based on fair value of equity share at 5th year. So today, there is no meaning of doing the valuation. Valuation must be done at the end of 5th year. And if at that point of time, fair value of one equity share appears to be 500 rupees, then one preference share will be converted into 2 equity shares. If fair value of equity share appears to be 100 rupees, then one preference share will be converted into 10 equity shares. So if the ratio is fixed, but better to get done the valuation now. If the ratio is variable, then the valuation should be done at the time of conversion. Okay. Now, the next thing. Buyback of shares. There is one more question from Asha ji. I understand upfront valuation and determination of conversion ratio is compulsory. Is it correct? Yes, Asha ji, what I can say over here is, if the conversion ratio is variable, then valuation of equity share as of today is not fruitful. Then as of today, you should do valuation of only preference shares. But if valuation, suppose I am saying the preference share has a face value of 1,000 rupees, we will give you dividend at the rate of 10% per annum for 5 years. After 5 years, the conversion ratio is variable. So today you just make valuation of the plain simple preference share without considering anything about the equity share. After 5 years, valuation of equity shares will be required. Today, even if you do valuation of equity shares, it's not going to be fruitful. And it is not compulsory for the company to issue the preference share which have a fixed ratio today. FEMA is yes, exactly. If you're talking about FEMA, then under FEMA, it is compulsory to decide the ratio today. And if you don't decide it, then there is a different thing that you need to decide at least the maximum number of shares and minimum number of shares which may be issued. Especially the maximum number of shares which may be issued. So even if the fair value of equity share drops drastically over a period of 5 years, still you cannot allot 1,000 equity share to the investor. Yes, under FEMA deciding a ratio today is important. Exactly, right. So this is, okay. Now third point here is buyback of shares, but we are not talking about section 68. Sorry, buyback title itself is misleading over here. I'm sorry about that. 68 is about buyback of share. 67 talks something which is ancillary to buyback. What is that exactly? So any employee based, any share based payment to employees, whether it is ESOP or it is employee stock purchase scheme, or it is stock appreciation right, or it is general employee benefit scheme, or it is retirement benefit scheme. There are two ways of operating any of these schemes. Number one is directly. So there are 10 employees to whom you want to give ESOP. You give them individually. Mr. A, Mr. B, Mr. C, Mr. D. I contact each of them individually and I give option to each of them individually. This is one way. The second way is to operate it through trust. So first you create the employee welfare or employee benefit trust. And then the trust, you allot shares to the trust, and in turn, trust will allot shares to give shares to the employee. So most of the experts, they don't prefer to go through trust. But yes, some people say, some people still go with the trust thing. Now, when you issue shares to employee, your number of shares in the company will rise. And definitely it will dilute the control of existing owners. Now, this is sometimes for a company where 100% shares are held by the family people, that's not a problem. But for a genuine joint venture, so several years back, there was a company which was running a very popular TV channel where 49.6% investment was made by the foreign partner and 50.4% investment was made by the Indian partner. So Indian partner was having just 0.8% shares extra. And that gives the controlling interest. And to buy just the controlling interest shares, the foreign partner at some point of time was ready to give 600 crore rupees to the Indian partner. That give us 0.5% shares in the company. 0.5% shares are not worth 600 crore rupees, but this is the controlling interest we will be getting in the company. Obviously, it must be allowed under FEMA, first of all, FDI policies. And then they tried to acquire it, but that deal never happened actually. But controlling interest is sometimes actually very important. So when you issue ESOPs to employee, your controlling interest actually dilutes. So one of the mechanism is you form a trust, and then trust by share from existing members to contribute to the ESOP pool. Obviously, company will fund that money. Company will give money to the trust. Trust will buy shares from the market, from existing investor, and then there will be a pool of shares which will be used for ESOP or other employee benefit scheme. But here the problem is, if that trust is going to market, is going to existing investors to buy shares, then that valuation, that share must be valued by a registered valuer. In a normal course, transfer of share is not to be valued by the registered valuer, but in this particular case, it should be valued by the registered valuer. Now, the next provision under the Companies Act is, usually people don't look at it carefully. So when I was reading it, I found this extra point, Section 73 and deposit rules. When we read it together, there is a scope of valuation work. I think that valuation work, there are three categories of valuers. One is the security valuer, other one is the land and building valuer, and other one is plant and machinery valuer. So under Section 73, the scope is more for the land and building and plant and machinery valuers, which are essentially engineers. So when I read rule number 2 of acceptance of deposit rules, it says that deposits definition is given and n number of exceptions are given, that all these things are not considered to be deposit, because once it is considered to be deposit, the compliance is like hell. The compliance will be very difficult. Debentures are not treated as deposit if secure. So unsecured debentures which are not convertible, which are not listed, are treated as deposit. Neither convertible, nor secured, nor listed, then it is a deposit. And there are lots of limitations for taking deposit. But if if debentures are secured, then they are not treated as deposit. But there are more conditions to be followed. Number 1, there must be a first charge on the asset in favor of debenture holders. Number 2, the asset is one which is mentioned in Schedule 3, the schedule for balance sheet and P&L. And the charge should not be on intangible asset. It should only be on tangible assets. And suppose company is planning to issue debentures of 500 crore rupees. So the value of the property which is to be charged should be equal to or more than 500 crore rupees. Now, how do you decide that what is the value? Say you are land, building, plant and machinery, you are creating a charge in favor of the debenture holders. So how do you know that the value of land, building, plant, machinery is 500 crore rupees, is 5 crore rupees, is 5 lakh rupees? So that valuation should be done by the registered valuer. Obviously, the security valuer cannot do it. It should be done by the engineers, that is the land and building or plant and machinery. Now here I would like to tell you one more thing. Suppose your client is a colonizer and he is saying, I want to make preferential allotment of share. So before pandemic, I made valuation of one such company, which is a real estate company. Now, what happened? If you look at their profit and loss account, it is not promising enough that I can say, wow, what a great profit. And on the basis of profit, I can say that the value of the company is 20 crore rupees. No, it was not. So income approach I rejected, and I chose cost approach. So they were having inventory, obviously inventory in the form of the raw land as well as the developed land and the developed plots which were not yet sold. So major part of their balance sheet was actually this land in the form of inventory, and I had to make valuation. So one fellow chartered accountant approached me and he said valuation is to be done. I said, yes, very well, I will do it. But let me inform you that the client will have to bear two fees. One for the securities valuer and other for the land and building valuer. So first we engaged a land and building valuer. He made valuation of the land. Building was not there actually. He made valuation of the land. He gave me the report, and on the basis of that report, by making several other adjustments, I arrived at the value of the shares of the company. On that basis, preferential allotment was made. Now, the next thing, 192 subsection 2, non-cash transfer of assets to or by the director. Ravi sir is asking, is there any scope of valuer in GST supported by the GST Act or the rule or regulations thereunder? So far, no. Registered valuers are not yet invited to the Goods and Service Tax Act. But there is one valuation draft bill. One draft bill on the valuation has been prepared by government. And if that becomes reality, maybe it will take 2-3 years. Maybe because valuation is a separate profession in all developed countries. So if this draft valuation bill becomes reality, in that case, whatever under SARFAESI, under Securities Contract Regulation Act, under GST, under Wealth Tax Act, and under all the acts, wherever valuation will be required, that will be allowed to be done only by registered valuer. But that is far from reality. And in that case, the valuation course will become just like a CA course. That is, the 4 years course will be there after doing the 10+2. And the articleship type of thing will also be there. And that will become a full-time profession. And after some years, they will say you cannot have 2 COPs, one of valuation and one of as a chartered accountant or company secretary. That is proposed. So if that happens, then yes, Ravi sir, then there will be scope. There will be scope under the GST also. Currently, there is no scope. In fact, even under CIRP, that is the Insolvency Act, whenever the valuation of inventory comes into question, so yes, securities valuer do it, but most of the securities valuer refrain from doing valuation of inventory, and rather than they leave it to the plant and machinery people or to some other expert. So yesterday only I got one message from one of the fellow chartered accountant from Delhi, and he said that bank wrongly seized the stock. Client went to the court, they won the court case. And now court ordered the bank to give them compensation, and for this purpose, now valuation of inventory is required. So he was asking, can you consult me on this? I will do the valuation, you just consult me. I said, okay, yes, these are the documents which are required. And first of all, we will have to involve one more expert who knows about that inventory. Suppose inventory is some sort of chemical. Now I don't understand whether it is sulfuric acid or this is ammonic acid or what is this. So currently, SFA valuers refrain themselves from inventory valuation, and even if they do it, they involve one more expert who understands the inventory. Okay, so I was telling you, non-cash transfer of assets by the director or to the director. If company is acquiring some asset from the director, maybe a real asset, land, building, plant, machinery, or maybe his investment in some other company, or giving some of its asset to the director for a non-cash consideration. In that case, valuation of that item is required. So director has got 10% shares in one company, and he is giving those shares, company is buying those shares from the director. And in turn, company will allot him company's own shares to the director, further shares. So now again, two valuations will be required. Number one, valuation of company's own equity share as per section 62, subsection 1, clause C. And number two, the asset which is being transferred by director to the company, that should also be valued. If that asset is a security or financial asset, it will be done by the SFA valuer. If there is land and building, so that must be done by the land and building valuer. Under section 192, valuation may be required. Just feel free to post any of your doubts so that I also feel like alive over here. And one more thing, that if you want to speak out something, probably you can type it in the chat box, and somebody from admin must be reading those messages, so they can unmute you and then you can also speak out. You know, listening to one single voice for 3 hours is difficult. At least some other voices are there and people will feel good. Right, sir. So now on the next slide, I am combining 3 sections, 232 and 230, 234 and 236. All these sections are actually related to compromise, arrangement or amalgamation. Okay, one more doubt has been posted. Probably I missed it that. Okay. So guys, all these sections are related to compromise, arrangement, amalgamation, and merger. So let's discuss this. Just a minute. Section 230, read with 232. In case of merger of 2 or more unlisted companies, valuation of individual companies on, if the company is listed, then the valuation should be done as per the SEBI guidelines. There you don't need a registered valuer certificate report. Rather than, they have given 2, 3, 4 things, 52 weeks average and this average and that average and highest of this. So that can be certified by a chartered accountant. They are not requiring it to be certified by a chartered accountant, but as a good practice, people get it certified for listed companies. But as far as unlisted companies are concerned, so it was probably December 2019, we made one valuation of a Delhi-based company. So in their group, around 150 companies were there. And day by day, the compliance cost is rising crazily. For one company, you need a company secretary, a chartered accountant, and regular ROC fees is to be paid, and GST and Shop and Establishment Act and this and that and blah, blah, blah. Many things are required. Now, most of the companies are doing nothing. Even if you go for winding up of the company, it is going to be expensive. So many groups, they are merging their group companies so that they can reduce on the compliance cost. So there was a merger of 25 companies in one single company. So in total, 26 companies were there. One company was acquiring remaining 25 companies. And we made valuation for that. And the interesting thing was, those companies made investment in further other group companies. So we keep on digging till the last point and then did the valuation. In case of merger, you need valuation of, say, A and B companies are getting merged. So you need valuation of company A independently without considering the benefit which will arise after merger. And then independent valuation of B company also, again, without considering the benefit which will arise after the merger. And on the basis of per share fair value of A company and B company, then you need one exchange ratio. So the valuer has to give not only the valuation of individual companies, but also to specify the exchange ratio. And that report will be later submitted to the National Company Law Tribunal. So this is one thing. Now, second thing, in case of compromise or arrangement with creditors or debt restructuring, spelling mistake is there, excuse me for that. Then valuation of assets of the company, including intangible assets and goodwill, is required to be done. Now, there has been one interesting amendment in Companies Act in February 2020, and it has modified the related rule, which relates to section number 230 of the Companies Act 2013, that if a group of people or a single person is holding 75% shares in the company, at least 75%, then he can apply to National Company Law Tribunal under section 230 that he wants to buy shares of remaining 25% people, either all shares or a few shares, whatever he decides to do. So 75% majority can decide to buy out shares of 25% minority. For that purpose, they can go to National Company Law Tribunal and they can say, my lord, we don't want these people in the company, and kindly allow us, kindly force them to sell their shares. Now, tribunal will make it sure that, okay, you can actually kick them out, but they must be given a fair compensation. They must be given, this company is unlisted, so what is the fair compensation? In that case, the fair compensation, that the fair value of the share will be decided by the registered valuer. So it was March, first week of March 2020, before this coronavirus thing and lockdown happened here. So there was one interesting case. So one of my fellow valuers, he was seeking my advice for valuation. And he said the case is something, who appoints the valuer? Yes, I'll come to that point. And Vijay sir has also posted a question. I'll come to both points. He said that there is a company and the situation is like that 75% shares are held by the husband and 25% shares the husband bought with his money in the name of his wife, like a dummy shareholder. After several years, there was a family dispute and the divorce case was pending. And I don't know who was right and who was wrong, but whatever was updated to me, I'm telling you. And the lawyer from the side of the wife, he said that, look, buddy, we will not leave this company. Even if you give us a fair compensation for these 25, number one, the shares doesn't belong to them. On paper, shares were there, but actually the money was of the husband. But anyways, on papers, it belongs to wife. So wife can claim that amount. But her lawyer was saying, he wanted disproportionately high compensation for those shares. And this fellow, he said, if you don't do it now, we will always remain there in the company and will not allow you to sell this company to someone else because you are no more interested in doing this business and you want to sell it. We won't allow you to sell it. So now what happened? In February, this amendment came and in February end, then finally that gentleman went to NCLT and a valuer was actually appointed to make valuation, and he has the right that he can buy shares of remaining 25% people at a fair value, which is decided by the registered valuer. Now there are two questions. Asha ma'am is asking, who appoints such a valuer? So registered valuer is appointed by audit committee of the company, if the company has the audit committee. If there is no audit committee, then the registered valuer is appointed by board of directors. Meanwhile, Vijay sir is asked, if company issues shares for other than cash consideration for acquiring IPR without obtaining registered valuer certificate, do allotment becomes void ab initio? No, it's not void ab initio, but it is a non-compliance. And for the non-compliance, suppose let's twist the situation. Okay, so it's a non-compliance, and in case of non-compliance, the penalties will be there, and there must be some mechanism through which it can be rectified. See, currently what is happening, that even if some people don't get the valuation done and they file PAS 3 and they don't attach the valuation report, or they attach the valuation report of a person who is not qualified to give the report. As of now, for small companies, probably the ROC is not bothering, so it is happening. Okay, type of thing is going on. But yes, it's a default, but share allotment will not go void ab initio. It is just the non-compliance, so it need to be made good. Asha ji is asking who, okay, sorry, audit committee. Yeah. Okay. Do you think board of director appoints such a valuer? Independence can be compromised? See, like I am the friend of the director. Okay. Now, in Companies Act, I will probably, I was about to come to that point. Let me check just a minute. So independence of registered valuer, if we are talking about, it is something like this. I'm sorry. Valuer should not have a direct or indirect interest at any time during a period of 3 years prior to his appointment as a valuer or 3 years after his appointment as a valuer. So if you are auditor of the company, you cannot be registered, and you are also a registered valuer, then in that case, you cannot say one of the partner is registered valuer, he cannot issue the report. You were auditor last year or before last year or before last year, still you cannot give the report. If you have given report as a registered valuer, then for next 3 years, you cannot become auditor of that company. So minus 3 years to plus 3 years. For 6 years, you should not have direct or indirect interest in the company. So now that is the problem. But say if you're saying, what if the valuer compromises his report? So in that case, there are rules and regulations which punish valuer also. Say one of the directors is a friend of mine and he appoints me as a valuer and he influenced me that you are my good friend or तेरे को मेरी दोस्ती कसम, and I say okay buddy, for you I will do anything, and I do give a wrong value, and suppose that affect the interest of the minority or some other people, then they can definitely change it in NCLT. And if NCLT feels like that this report is not right, they can appoint a valuer from their side. And if the valuer's report, if my report is kind of thing, then I will be punishable. So professional, mistakes and compromises are going to be very costly. This draft valuers bill, what it is saying, the government, there will be no regulating body. Directly government will control the registered valuer, and each year they will take some of their draft valuer bill is just a draft, and then it will be a bill, and then it will be act. But when it becomes the reality, what they say, every year on sample basis, some of your reports will be drawn and we will check it. And if it found to be deficient or incorrect or there is some fraud, then huge punishments are there, which runs in several crores of rupees. So you must, you're already doing practice, so you must realize that doing such type of things, at small level, sometimes it may work, but ultimately the cost is very heavy. So in one case, I was not there, but one of my fellow speaker was there. This valuation profession was there even when the registered valuer thing was there. So 10 years back, one of the valuers made valuation of equity shares of the company, and he clearly mentioned in the report that we are giving report for internal purpose of the company and it cannot be used for any other purpose. But Unit Trust of India at that point of time, maybe it is 15 years back case, they invested in that company on the basis of that valuation report. And ultimately, that company became bankrupt. And the Serious Fraud Investigation Office gave the notice to the valuer. And if you get notice from SFIO, it's like hell. But that person, he was having a bunch of working paper properly. Hello. Anandji, am I audible?
Yes, sir, you are audible, but network is not stable. वो voice थोड़ा fluctuate हो रहा है.
Okay. हाँ, मुझे actually I lost connection. Your internet connection is unstable. Even I am seeing this message. Let me check the. Okay, just give me a moment. I will just check it. So actually, Airtel and Jio both are not giving fiber connection in my area. Though they are offering this 50 Mbps speed, but it is unstable.
Now, but your voice is clear, sir.
Okay, thank you. Might be so technology has both aspects. It becomes a problem also.
Yes, sir.
Sorry, so I lost the chat box also because I was suddenly thrown out of the session. So if you have posted any doubts earlier or any questions earlier, right. So whether valuation required when unsecured loan converted to equity and the said shares issued at face value and the company is into losses. Okay, Chaitanya ji is asking conversion of unsecured loan into equity. See, you are issuing equity, this is for sure. And you are issuing equity to the selected people who have given unsecured loan. So this is actually preferential allotment. Guys, I'm really sorry for the disturbance. This is beyond my control. The speed test is also showing me that I am getting a good speed. I don't know what is happening. Okay, let's continue. Okay. Ping test. Okay. I will do that. Thank you, Chanel ji. So the question was, you are allotting shares to the people who provided unsecured loan to the company. So if you are giving them, what I understand from your question, Chaitanya ji, that when taking the unsecured loan, it was nowhere written in the terms and condition that if company makes a default such and such, then it will be converted into equity shares. And later, probably you entered into an agreement with the company that the unsecured loan guys will be allotted shares in the company because company may not be in a position to repay them. So that is preferential allotment of shares. And in that case, even if the company is loss making, on the face of it, you can say that the net worth is negative, future earning potential is not there. But that you are saying, but you need a certificate. You need a valuation certificate from the registered valuer who will say, yes, I have checked it. Suppose I am the accountant, not the chartered accountant. And I look at the accounts and I say, I guarantee that accounts give a true and fair view. But I'm not the authority to give that certificate. And that's why a chartered accountant is needed. And similarly, if unsecured loans are given equity shares in the company, 62(1)(c) preferential allotment will be applicable. And even if the company is loss making, you need a valuation certificate, valuation report, which will say that the value of share is nil. And once the valuer certifies that value of share is nil, then company can obviously make an allotment at a price above the price given by the valuer. So then you cannot make allotment at discount. So definitely you will have to make allotment at par value. I hope that answers your question. Okay. So one or two more doubts were there, but probably you'll have to post it again. So right guys, compromise and arrangement section 230, 232, and here this valuation report is required. Now cross-border merger, it is also on the same ground. If a company registered outside India is to be merged with a company registered in India and vice versa, so that is essentially a merger. And that's why again section 234 specifically says that valuation is actually required. Winding up of the company. Now there are two ways for voluntary winding up of a company, either under the Companies Act or under IBC provision, Insolvency and Bankruptcy Code. So nowadays people find IBC route to be, comparatively faster. But even if a liquidator is appointed over here under section 281, the liquidator will prepare various reports. And the report on assets of the company, valuation report, should be prepared by the registered valuer only. So these were all provisions which were making it mandatory to get done the valuation. Now some provisions which make it recommendatory, optional to get done the valuation. I request all of you, if you have posted any doubt before this disconnection, please post it again, because in my chat box, no more chats are there. Okay, so now recommendatory provisions, 61 subsection 1 clause B of the Companies Act, consolidation of nominal value. Company says that your 10 rupee share, 10 shares taken together will consolidate into 100 rupees par value share. Now I am holding just 6 shares in the company. So after consolidation, I'll have 0.6 number of shares. And that's a problem. Those are fractional shares actually. So what to do with that? So usually what do the company do? Company will buy these fractional shares and give cash to you. Or sometimes a company appoints a trustee to buy fractional shares from investors, and then trustee will then pay cash for those fractional shares to the investor. So Companies Act doesn't say that get valued the share, but you're giving cash instead of giving shares. So it is recommendatory, it is advisable that the valuation should be done over here. It's not compulsory. 62(1)(a) right issue. We have already discussed it, where some shareholders renounce their right in favor of other shareholders. There is no compulsion of valuation over here. But as a good practice, as a prudent practice, the valuation should be done, so that tomorrow nobody can raise a finger that you have done something wrong, and you will have everything in your record properly documented. The next thing here is reduction of capital under section 66, where besides reduction of capital, you're trying to squeeze out the minority shareholders also. So you can say the controlling interest in the company is actually changing. So in that case also it is recommendatory to get valued the shares of company. Buyback of shares. Now here I must tell you one thing, that practicing chartered accountants are certifying value over here. It is not the requirement of the Companies Act, but if the company is going for buyback, then there must be some rationale behind the price that we want to buy shares at this price. It must be documented. So either it is calculated by board of directors, or it is calculated or certified by a third party, like practicing CA. So that becomes a good corporate governance, and therefore it is recommended for buyback. It's not a compulsion. But yes, under buyback, if NRI shareholders are involved, then obviously you'll be caught in the provisions of FEMA, and then a valuation by chartered accountant will be must. Okay, in 62(1)(a) situation, how we deal the same in income tax. RK sir, definitely we will discuss it. We have enough time and we will discuss provisions of Companies Act. Just soon after this slide, we'll start discussing provisions of Income Tax Act, and there we will discuss it, sir. Then 242 subsection 2 clause B, tribunal may appoint valuer in case of operation and mismanagement. So somebody made a complaint under section 241 to NCLT that there is operation and mismanagement in the company. So now NCLT has two choices, either to wind up the company, or NCLT has many other options. So one of the options which is available to NCLT is NCLT can order that shares of Mr. A should be bought by shares of Mr. B. So if such kind of thing happens, then valuation is recommended that this should be done at a certified value so that nobody can say in future that it was unfair for him. Okay, merger of wholly owned company. So I am A Limited, my subsidiary, 100% subsidiary is B Limited, and I decide to merge that subsidiary into the holding company. You don't need any exchange ratio. You don't need any valuation. That is your own company. In that case, just one report is prepared and a practicing chartered accountant can make that report, and that is share entitlement report. That's it. But as a good governance practice, the valuation should be done and it should be kept in record. It is recommended. Now, demerger. What happens in case of demerger, and is the valuation required? That's a question now. So demerger may be in the nature of spin-off. Like there is a company named as ABC Industries Limited. There are some shareholders. The single face is representing thousands of shareholders in the company. This company has two divisions. One is the steel scrubber manufacturing division, and second is the software development division. Now, company ABC Industries Limited wants to demerge the software division because software division is not getting proper attention. If it is run in a separate company, it will get good attention. So they form a new company, ABC Software Limited. The promoters themselves, they form a new company, ABC Software Limited. This business division of ABC Industries Limited will be transferred to ABC Software Limited. And this is actually named as spin-off. Now, ABC Software Limited has got a new business division. It bought a business division and it need to pay consideration. So this company, ABC Software Limited, it will issue its shares to the existing shareholders of ABC Industries Limited in the proportion in which they are holding shares in ABC Industries Limited. So now I'm asking one question, and it will test also that the participants are active over here. All right, sir. One question to all of you, and everybody, it is compulsory for everybody to post the answer. Even if you don't know it, you guess it. Even if it is very simple for you, answer it. It will be taken as attendance. So my question here is, what will happen to the fair value of ABC Industries Limited after this spin-off? What will happen to the fair value of ABC Industries Limited after this spin-off? Number of answers is equal to number of active participants. My humble request to all fellow members. Okay. And yes, the answer is correct. Obviously, the fair value of per share or in total for ABC Industries Limited will reduce. And the shareholders, in that case, can I say that shareholders in ABC Industries Limited will be at a loss because the fair value is reducing? No, exactly. Perfect, sir. you don't suffer a loss, because now you're getting shares in ABC Software Limited. In fact, maybe you're unlocking the value. Earlier, ABC Industries Limited was valued at 10 crore rupees. After demerger, it becomes 6 crore rupees. But ABC Software Limited also becomes 6 crore rupees. So 6 plus 6 together, it will become 12 crore, which was earlier 10 crore only. So maybe you can unlock the value by demerger. Yes, exactly. Yes, sir. So now the thing is, yes, exactly. Irwin Limited. Yes, it was a very popular demerger. And the total value will be higher in case of fair value. Exactly. You're right, sir. So this is the thing. Now, there is no requirement of valuation because you're getting share in proportion. But if due to demerger, due to something, if the proportion of the shareholding is changing, then the valuation should be done. Otherwise, it is recommendatory and not compulsory. So as we have already discussed, and now Companies Act has interestingly not defined that what is direct interest and what is indirect interest. So it is your own call. It is your own prudence that how much ethics do you actually follow. You take a call whether I have interest in this company or not. So I was making valuation of one of the unlisted companies, and company had issued some 10 crore shares, and one of my close relative was holding 3,000 shares in the company, and I was supposed to make valuation of that company. So I took advice of some of the senior people, and they said that, even if your close relative is holding share in this company, it actually doesn't affect you because the shareholding is very small. So they have not defined what is direct, what is indirect, how much percent and everything. So you do the valuation, and you disclose it in the report that this interest is there. RK sir is asking, sir, here a question: auditor deemed to be independent, how he is interested? Interested means dual relationship with the company. Number one, as auditor. Number two, as valuer. So as a valuer, if you are doing something wrong, as an auditor, you will hide it. No, valuation was perfect. I said, no, I did valuation for a company where the auditor was Big Four, and they grilled me for each and everything I did. In fact, nowadays a new practice is there that the Big Fours or Big Eights, now whatever you name it, what do? When they do auditing? Valuation has already been done by someone else. They appoint a separate third party. It's not a requirement of law, but they want to have a comfort. They appoint a third party, a third valuer, and ask him that whether this valuation, review this valuation and give us the comfort that is it correct? Because if this valuation changes, the fair value changes, the balance sheet size changes, our audit report also changes. So independently from their side, by paying fees from their own pocket, maybe it is indirectly recovered from the client, they consult independent people also to get a comfort. So dual relationship is then you are not independent, then you may be biased. In case of sick companies, is the valuation needed? No. But if the sick companies goes into insolvency and bankruptcy code process, CIRP process, then the insolvency professional will be appointed. And then in fact, 6 valuers will be appointed. In IBC, for each single case of IBC, 6 valuers are appointed. If required, 2 valuers for land and building, 2 valuers for plant and machinery, and 2 valuers for security or financial asset. So 2 valuers of SFA will give the valuation, and then on that basis, insolvency professional will decide that if this company is somebody is ready to buy, at what price should I sell this company. So for becoming sick itself, valuation is not required. But if the case goes in IBC, then valuation will be required. In that case, the board of director or audit committee will not appoint the valuer. In that case, the insolvency professional will actually appoint the valuer. Right, sir? Now coming towards the more interesting part, that is the Income Tax Act. Now, valuation under Income Tax Act is more methodical than logical. Maybe. So let me first give a disclaimer. I am not a tax expert. I'm not into the traditional practice. I just do the valuation practice. I'm expert of that. You can ask me any question related to that. But when it comes to income tax, yes, I know provision related to valuation. But if you ask me what was the decision of ITAT or Supreme Court or High Court, then I will raise my hands and I'll say, sorry. In that case, some of you will have to answer that question. Okay. If any depth of the tax question arises, then one of the participants will have to answer it. With this disclaimer, we are indulging into it now. Right, sir? Okay. So securities valuation under Income Tax Act. I have broadly categorized it into 4 parts. At the time of issue of shares by unlisted companies, section 56(2) clause 7b. At the time of sale of unquoted shares by the shareholder, section 50CA. When any person receive any security, kind of gift under section 56(2)(10). And number 4, sale of shares of Indian company by foreign entity, section 9 subsection 1 clause 1. The notorious section, the infamous case of Vodafone India. Finally, we lost that case in international arbitration, and that actually damaged our goodwill as a country, that we can do the retrospective taxation, and until ultimately international arbitrators denied that no, this is not fair. So let's discuss it one by one. Very interesting things will, when it comes to income tax, it becomes more interesting. Issue of securities by unlisted companies. So for section 56 subsection 2 clause 7b, applicability. When a company, obviously I'm talking about unlisted company, that is a company in which public is not substantially interested, issue shares at a premium. So if unlisted company is issuing shares at par, it is out of the scope of this 56(2)(7b. It does not have to bother about it. But if unlisted company is issuing shares at a premium, फिर भले वो 10 वाला शेयर 12 रुपए में ही क्यों ना इशू हो रहा हो, प्रीमियम तो प्रीमियम है. Then amount received in excess of fair value is income in the hands of company, is taxable in the hands of company. So if the fair value of the share is ₹20, face value is 10, fair value is 20, company issued shares at ₹50. So this excess 30 rupees, it is the deemed income in the hands of company. It is taxable in the hands of company. So probably someday somebody told me that some of the politicians from South India, they actually raised this concern to the government. They took crores of rupees by issuing shares at a premium. So that was the legal form of bribe they were taking. Thereafter, government came up with this section. RK sir is asking, in case of family settlement, share of a private company is transferred from a member to another member. The company has also subsidiary. For the purpose, is merchant banking valuation report required? No, sir. Under Income Tax Act, for transfer of share, transfer of equity shares, better I say, just the balance sheet valuation will be enough. Merchant banker is not required. Even the chartered accountant's certificate is not required, but people actually take it. And you should also advise the client that, please, buddy, take it, keep it in your records. That will be helpful to you. So merchant banker valuation report is not required for transfer of shares, especially. We'll discuss 50CA for that. 50CA, we'll just discuss it. Now, so if 20 rupees fair value, I'm issuing share at 50 rupees, 30 rupees is taxable in my hand. That's a problem. Okay. But who is exempted from this? Shares issued to non-residents. If you're issuing shares to non-residents, in that case, it is regulated by FEMA. So Income Tax Act said, okay, now we are not bothered. whatever is the fair value, we don't bother. You issue the shares at whatever price you wish to issue. This section is not applicable in case of issue of share to non-resident. This section is not applicable in case of issue of share to venture capitals. So now in this startup culture, unbelievable valuations are happening. Unbelievable. Zomato issued its 10 rupees par value share at 1 lakh rupees. Well, what kind of valuation is this? By doing A plus B plus C plus D minus L, or by doing A minus L, you can never arrive at the valuation of 10 rupees share valued at 1 lakh rupees. Crazy people. But they are not manipulating. They are crazy. Yes, I agree. But they are not manipulators and making black money white. No. They are genuine venture capital funds. They see something over there, and that's why they are investing money. So government said, okay, you're issuing shares to venture capital at a very huge premium. Don't worry, go ahead. 5627B will not obstruct you. Then one more exception, category 1 and category 2, alternative investment funds. In mutual fund, public at large invest. Alternative investment funds, they invest in unlisted securities. They are governed properly by SEBI and everything. So government said, okay, this is also not a place where money laundering can happen. So let's exempt category 2 and category 1 and 2 alternative investment fund. If company is allotting shares to them, even if it is at huge premium, we don't bother about it. Now this number 4 is a lifesaver. Startups registered under Department for Promotion of Industry and Internal Trade, DPIIT. If a company is registered as a startup with DPIIT and fulfills several conditions, then 5627B is not applicable. And in the month of July, we did valuation of 2 startups, and one startup was at idea level, zero implementation of idea, but just idea they were having. They started investing money. We valued one share of 10 rupees as a fair value of 8,000 rupees. Crazy price. But investor is ready to give that price. So now startup was registered with DPIIT. No need to follow section 5627B. And they were exempted from this provision. Otherwise, if these 4 are not the cases, then there is a problem. Now two valuation, I'll tell you. First, let me go point by point. This is about applicability of 5627B. Other than these cases, you will need valuation, because they are saying if you're getting money more than fair market value, then that is taxable. So what is fair market value? If this section is applicable, then you need to identify fair market value. Issue of equity shares by unlisted companies. How to make the valuation? Suppose you are not exempted, so fair market value is required to be calculated. Fair market value of equity share as per rule 11 UA, sub rule number 2, they have given 2 choices. Either you go with the book value method. In that case, chartered accountants usually certify, which is not the requirement of law, but actually they certify. And number 2 is discounted cash flow method. What is book value method? It is A minus L into PV upon P. A is book value of all assets. So as per your balance sheet, land, building, plant, machinery, furniture, fixture, inventory, debtor, cash in hand, add it. Then as per your balance sheet, deduct the long-term loan, the short-term loan, debentures, and preference shares. Don't deduct paid up equity, share capital, and reserves and surplus. I'm not going into minute details, but yes, book value of asset minus book value of liability, that's kind of net worth. That's kind of net worth of the company. So you arrive at net worth of the company and divide it by number of shares to arrive at per share value, and then multiply it by number of shares which you are going to issue to arrive at the size of the deal. I'll take one example for the same. Now they are taking book value. So book value should be taken from audited balance sheet, not the unaudited one, because the chartered accountant certifies it. And chartered accountant sign is a sign of trust. Audited balance sheet on valuation date. But sir, my company is issuing shares on 14th of October. So should I get it audited on 14th of October? So extra audit fees and extra effort is required in that case. So government says, okay, look, buddy, if on the valuation date audited balance sheet is not available, then whatever was the last audited balance sheet which has been adopted by AGM, take that. So today, if I'm making issue of share and 31st March 2020 balance sheet has been audited and accepted by the AGM, so we will take that balance sheet. And if I want to, if I want to prove a higher value, then I'll get it audited. See, 31st March, if it's a profit making company, so 31st March 20 value will be comparatively lower. And 14th October 2020 value will be comparatively higher because in this 6 months time period, company earned some profit. So value increased. So if I want to show that my fair market value is high, which actually I would like to show, so I'll get it audited. Otherwise, I can use the previous balance sheet. Let's take one example for the same. So we have this Excel file. So this is the situation. Land and building, book value is 50 lakh. Plant and machinery, book value is 50 lakhs. Other fixed assets, 10 lakh. All as per audited balance sheet. Current assets worth rupees 30 lakh. Current liabilities worth rupees 15 lakhs. Including short-term debt, okay. Debentures 25 lakh. Reserves and paid up share capital. Definitely these two items I won't deduct. Number of equity shares which are in existence are 2,50,000. Number of equity shares proposed to be issued are 37,500. Now, if you tell me to make a valuation, I will do a very simple exercise. I'll say equal to sum of all assets. So these are all assets. This is book value of assets minus sum of book value of all liabilities. So that is 1 crore rupees. 1 crore rupees divided by 2,50,000 number of share. So book value per share is 40 rupees. This is fair value now. Now I can multiply it by 37,500 to arrive at the total amount. But 40 rupees is the fair market value. And if I issue share at 100 rupees, 60 rupees will be taxable in my hand. This is the book value method. Even if the land and building has a stamp duty value of 2 crore and plant and machinery has a value of 3 crore, other fixed asset has a value of 1 crore, it hardly matters what is the market value of your land, building, plant, machinery, furniture. Forget about it. Just concentrate on book value. You cannot take market value, stamp duty value. No. For section 56(2)(7)(b), you cannot take that. Right, sir? So now my share is not worth 40 because book value is on very lower side. My earning capabilities are higher. So my market value should be, fair value should be 200 rupees. Then prove it that it is 200 rupees. So instead of using the book value method, now the assessee would like to shift to the discounted cash flow method. And in this case, merchant bankers valuation will be required. So merchant banker means very high fees. Minimum, their fees quotation starts with 50,000 rupees, something like that. Here, chartered accountant was there earlier, but later they deleted it. Now they are talking that the registered valuer will be there, but they are just talking. They are doing nothing about it. So merchant banker need to be engaged over here. This is issue of equity share by unlisted company. Okay, right, sir. Now, section 56(2)(7)(b) actually talks about issue of shares. Share includes not only equity shares, but also preference shares. The interesting thing is this preference share may be optionally convertible, may be compulsorily convertible, may be non-convertible, may be redeemable in 5 years, may be redeemable in 10 years. Any kind of design and creativity is allowed in preference shares in Companies Act. So I design optionally convertible preference shares. So if unlisted company is issuing OCPS, again 56(2)(7)(b) comes into role because 56(2)(7)(b) is for issue of any shares, not just for equity shares. This is what I understand. Here in this case, the valuation will not be as per sub rule number 2. Rather than the valuation will be as per sub rule number 1 clause C subclause C, which says fair market value of other securities and equity shares will be the price which one can obtain if those shares are sold in the market. And who will certify that at what price the share can fetch? Either a merchant banker or a chartered accountant. I told you right in the beginning that there is a scope for practicing chartered accountants to make valuation under the Income Tax Act also. So as far as securities other than equity shares are concerned, either a merchant banker or a practicing CA should certify, should calculate, should make a report for that value. This is issue of shares by unlisted company. And you know, DCF is the best technique, because if you go by book value, the book value will be like this only, and the DCF may be like that. And then you will like to issue shares at the high price. Now, probably the question like RK sir was also asking, sell off unquoted shares. Now, selling of share. Under Companies Act, for transfer of shares, valuation is not required. But under Income Tax Act, for transfer of unquoted equity shares, unquoted shares, valuation will be required. If sold below fair market value, if the actual consideration received is below fair market value, then fair market value will be deemed to be the sale consideration for the seller, and accordingly the capital gain tax will be charged. If I'm selling shares in a company, even though it is under family settlement, then my sale price should not be below fair market value. If I'm selling at a price below fair market value, in that case, fair market value will be deemed to be the sale consideration received, and accordingly it will be taxed. How do I make a valuation? Now, this time government has given a different formula. Very clever people, they always make provision in favor of revenue and against the assessee. Fair market value of equity share. This is not rule sub-rule. This is not rule number 2. See, when company issue shares, it follows sub-rule number 2. I'm sorry, it follows, yes, sub-rule number 2, which is simply A minus L. But when it comes to sell off share, it is not 2, it is 11 UA rule number, sub rule 1, clause C, subclause B. And now this is not A minus L, this is A plus B plus C plus D minus L. Divided by, you know, simply instead of saying PV by P, let's make it simple, divided by number of equity share, existing number of equity share. So in family settlement case also, this rule will be applicable, sir. A is book value of all assets. Fantastic. B is, now you're not taking book value. Now you're taking fair market value of jewelry and artwork, which will be certified by a valuer registered under the Wealth Tax Act. If there is jewelry or artwork in the company. C is fair market value of shares and securities. So if the company is holding shares in other company, don't take book value of those securities, take fair market value of those securities, and that fair value should be calculated like this: A plus B plus C plus D minus L. Stamp duty value of immovable properties. Don't take book value of land building, take stamp duty value, and then deduct book value of liability. So now the change, with the same example, the valuation will change. See, land and building, when company was issuing share, it was considered to be of 50 lakh rupees, but now it is considered to be 2 crore. So I will replace it by 2 crore. Okay, here. So just keep in mind, is 40 rupees I am writing. So when company was issuing share, it was worth 40 rupees. When I am transferring share, this is 2 crore. Stamp duty value of land and building is 2 crore. Market value of land and building is 3 crore. We cannot take market value. We will have to take stamp duty value which is accessible for stamp duty. Plant and machinery, it must be taken at book value. Other fixed asset, it must be taken at book value. Jewelry, artwork, painting, other investments are not there. So all other things are same. Now look here. When I am selling share as a shareholder, government says pay tax according to the 100 rupees value. But when company is issuing shares, government says you cannot issue at a price more than 40 rupees. If you issue at 100 rupees, 60 rupees will charge as tax. Now, these two sections are not contradicting, but I'm saying that when it comes to the revenue says when both the sections are in favor of revenue. Here they will charge the higher capital gain tax from the seller, and here they will say, company, look buddy, if you issue beyond this price, you will be taxable. Okay, what does PV and PE denote in that formula? Let's come back to the formula. So PV means, PE means the paid up equity share capital of the company before issue of these shares. And PV is value of shares, paid up value of shares which you are going to issue. So PE means existing paid up capital and PV means the proposed paid up capital which is to be issued. Rather than doing this, you simply divide, rather than multiplying by PV and divide by PE, you simply divide by number of existing shares to arrive at per share value, and then accordingly you can make calculation, right sir? So government is very clever and उनके लिए दोनों साइड फेवरेबल उन्होंने प्रोविजन बनाया. Now, what about this? Is about the seller of share, and now this will be about buyer of the share. Seller of share, buyer of share. Now 56 subsection 2 clause 10, it talks about if you receive any security. So guys, look like stamp duty value on the balance sheet date or date of transfer. Obviously, if stamp duty value, you should take on the valuation date. If I'm wrong somewhere, you can definitely correct me, but it should be on the valuation date. So you receive any security under section 56 to 10. They are saying receive. Now you can receive it as a transferee or you can receive it as an allottee also. So I guess this should be applicable in both cases, when I'm getting allotment of share from the company and when I'm getting share transferred in my name from the existing shareholder. In both cases, it should apply because it says receive. It is not saying whether you're transferee or you are allottee. So if consideration paid is less than fair market value, so 56 to 10 is for all kind of asset, including securities. I'm focusing just on securities. So if a security worth rupees 100, if you are getting it just for rupees 70, then 30 rupees is deemed income in your hand. Difference amount is taxable. Okay. Okay, one more thing I missed. If you are seller of equity share, then under section 50 CA, this valuation is required. But if you are seller of other share, like preference shares, again 50 CA is applicable. Seller of equity share, this is how you do the valuation. You certify the valuation. And seller of other securities, maybe optionally convertible preference share or optionally convertible debenture or compulsorily convertible preference share. Then how do you do the valuation? If sold below fair market value, the fair market value of preference share, a report from merchant banker or practicing chartered accountant is required. So if an unlisted company is issuing complex securities, if shareholder in unlisted company is transferring complex securities, there is a scope for valuation by a chartered accountant. In both cases, complex securities issue, complex security transfer, merchant banker / chartered accountant is still there under the Income Tax Act. That's something good for us. Okay, now the buyer of the security, if you're paying lower amount, the difference is your deemed income. Now again, if it is any quoted shares or securities, then how to calculate fair market value? If you're transacted through stock exchange, then whatever transaction value is there in the bill given by the broker, that is the fair market value. If you are getting any security which is quoted, but you got it offline personally, your relative gave it to you outside the market of National Stock Exchange or Bombay Stock Exchange, Then again, in the favor of revenue, lowest price, not exactly in the favor, I'm sorry for that. Lowest price on valuation date. So today, if the shares were transferred, so go to the Bombay Stock Exchange. I got share personally from you. I will look at the whole day's price at BSE. Whatever is the low price of the day will be considered to be fair market value. If I'm giving an amount less than that amount, this is my deemed income. But sir, today the share is not listed. In fact, for last 1 month, it has not been traded. Then whatever was the last traded that on that day, whatever lowest traded value was there, that will be considered to be fair market value for the receiver of the share, for the buyer of the share. If he's paying less than that, it is taxable. This is for quoted shares as well as securities. For unquoted securities other than equity share, again, practicing chartered accountant, merchant banker, OCPS, CCPS, OCD, CCD, practicing CA or MP. So this one report will help both the buyer and the seller. See, under the buyer also, OCPS was valued by CA. Under the seller also, seller and buyer both, this single report will work. But when it is equity share, the same thing, A plus B plus C plus D. This is not E, I'm sorry for that. This is minus L. So fair enough. For the buyer as well as for the seller, you are using the same formula, whether it is equity share or it is other security. Fair enough. This is right, sir. But 2 points. I'll visit this slide later. Okay, let's discuss it and then we'll move ahead. Okay, looks like I divided the entire session today into 2 parts. One is the legal provision and the second one was the hardcore valuation. So I guess today I will not be able to cover the hardcore valuation part. Maybe with today's session, many people get inspired for valuation. So then we will request Indore branch to organize one more session, maybe of 2 hours or 3 hours. And then we will not discuss any legal provision over there and we will discuss just valuation, how to do the valuation, because under FEMA you can do valuation, under income tax, some of the sections you can do valuation. So now how to do valuation, that may be covered in the next session. Now sell of shares of Indian company by foreign entity, the Vodafone case actually. The share of, if the share of Indian company is listed, then whatever value is reflected on the stock exchange, that will be considered to be fair market value. If shares of Indian company is not listed, then there is a need of valuation. If foreign company is holding shares in Indian unlisted company and it is selling those shares, then valuation is required either by a merchant banker or an accountant. Similarly, if the other securities are there, complex securities are there in Indian company, which are held by a foreign company and which are sold by foreign company, again, the valuation is required. The fair market value of other securities shall be the price it would fetch if sold in open market on specified date as determined by merchant banker or an accountant. So again, there is a scope for valuation. Now, if I summarize this whole thing, this is going to be beautiful, and one controversy also I'll discuss over here. So first, 5627B, issue of unquoted shares. If company issues shares at a price more than fair value, it is taxable. Equity shares, either A minus L formula or use the DCF, which is to be certified by merchant banker. Whatever latest balance sheet is available, which is audited, do the valuation on that basis. If it is preference share, then valuation will be done either by merchant banker or chartered accountant. Right, sir? So this is one. I'm just summarizing all the provisions under Income Tax Act. Then 56, I'm sorry for typing error. This is 56.210. Receive any security. So if you are paying a consideration less than fair market value, it is taxable in your hand. The share is quoted, take the transaction price. Otherwise, take the low price on the valuation date. Otherwise, take the low price on the last traded date. Unquoted equity shares, A plus B plus C plus D plus E minus L. Unquoted other securities to be valued by a merchant banker or chartered accountant. But here, one ridiculous thing is there. In a family settlement, Vidya ji has raised hand. So Amit ji is saying great session, very informative and qualitative. Thank you, Amit ji. Definitely, Vidya ji, you can speak out. So I request coordinator to please unmute Vidya ji. Vidya ji, just ping on the chat box, so it will be probably easy for coordinator to search your name. Okay, Vidya ji is saying please do session on how to do valuation practically. Definitely we'll do. But I didn't want to rush. So in the next session, we will do valuation of how to do exactly. And in that case, I will tell all of you to get ready with your Excel and everything, and then we will be working over that. Some quick guidance on IBBI valuation course. Okay, yes, that's fantastic. So meanwhile, a question is asked that how to pursue the IBBI valuation course. So very simple. First of all, register yourself with ICI RVO. ICI RVO has its own website. Go over there, register yourself, make payment to them. Probably now they are accepting online payment. And whenever the next batch is there, you'll get online session. A 50 hours training will be there. So usually that completes in 3 weekends, Saturday, Sunday, Saturday, Sunday, Saturday, Sunday, something like this. 3 or 4 weekends, they complete the 50 hours training. And once you complete 50 hours of training, so besides those 50 hours, you will have to devote seriously because valuation may be a new subject for some of you. Even if it is not new for you, still I will suggest that when you do this training, honestly take leave from the office and do the 50 hours training. And thereafter, you need to study 100 hours of self-study and then appear for examination. Even Indore is also one of the centers. It's online multiple choice question examination. You need to score 60% of marks. And with 60% of marks, definitely you will clear the exam. And its benefit for CA and scope. So today's session was basically based on the scope only. And benefit, today's session is on scope and benefit only. And definitely, all right, sir. So now one ridiculous thing here is when company is issuing shares, they say even the last balance sheet of 31st March 2020 is acceptable. But when shareholder is transferring shares, they say we need audited balance sheet on the date of valuation only. So if I am one of the shareholder in unlisted company and I am transferring my share on 14th of October 2020, they say we need audited balance sheet of company on 14th of October 2020. Sir, I am the shareholder. I am not in a controlling position maybe. How will I get that audited balance sheet? Now, this is a ridiculous provision. Company issuing share, it is allowed to use previous balance sheet. Investor transferring share, previous balance sheet is not allowed at all, neither for buyer nor for seller. You need latest audited balance sheet only. Now, how do you comply with this? The only way is if you have controlling interest, then get it audited. So in one case, we were doing this case, and auditor was one of the big four. And client said, sir, I cannot pay their fees again. They will charge huge amount of fees for this mid-date valuation. This will be a heavy burden on him. So the tax consultant was a smart guy and he said, okay, don't worry, I'll take care. How will he take care? I don't know. How will he take care? You don't know. So you are smart guys, you better know how will he take care. Tanmay is saying, wait till you get the audited balance sheet. Yes, that's another way. That's another way that you wait. But if you can't wait, then go ahead. And then you convince, because one of the provisions, then you convince the assessing officer, if he at all take an objection that, sir, even this unaudited balance sheet is authentic enough, please help me, kind of thing. Okay, so preference share to be valued by merchant banker, chartered accountant, unlisted shares of Indian company, 11 UB, valued by MBCA. So here you can see CA, and CA and CA. In all four columns, you can find chartered accountant. Right? Now there are two conflicts, very interesting conflicts are there. Conflict number one, under Income Tax Act. Feel free to post your doubts simultaneously, because continuously listening to one person is not tolerable. Right, sir? Okay, and in fact, I can see that some of you may be having some commitments also. And if you leave early and your doubts remain pending, then you can note down my contact number. And if you have any doubts later, you can ask me. I can see that some of you might have commitment and you may have to leave. So Subhiji, I can share, there is no issue. This is my number. This is my email ID. So if any of your doubt remains unanswered, you can contact me at this mobile number and email ID. In fact, I'll better like you to save it so that tomorrow if I broadcast any message related to some knowledge bites of valuation, you will instantly receive it on your WhatsApp. So please do save this number so that not only you can communicate with me, I will also be able to communicate with you if you save this. Right, sir? Okay. So let's get back to our business. Just a minute. Okay, so this is interesting now. Conflict number one. If fair market value under section 5627B, which is actually A minus L only, where all book values are taken, no market value is taken, is rupees 100. Okay. And the fair market value under section 56210, where A plus B plus C plus D minus L is done, and where I take the stamp duty value or the value certified by the jewelry and artwork valuer. So obviously, under 56210, fair market value is bound to be higher than the fair market value under 5627B, because 5627B, this is 5627B is just, A minus L, all book value. And 56210 is you're taking stamp duty value, registered value or value. So 56210 is bound to be higher. So 56210 is 180. Now, the classic conflict here is, if they are applying issue of share to 56210 also, if they are applying it at all, I don't know whether they apply it or they don't apply it. If company issue shares at rupees 100, then department will say, look buddy, share worth rupees 180, you got it for 100. Now it is deemed income in your hand, you pay tax on 80 rupees. And if the company decides to issue shares, actually, I shared my number not so that all of you leave the session. Those who have urgency, only those people leave the session. Those who have still some time left in their busy time, believe me, further slides are also interesting. And please stay here and you'll be benefited. It's my guarantee. So if company issued at 180, now the company is taxable because something worth rupees 100 you are issuing for 180. So on either side, there is a problem. This is a very ridiculous provision, if at all 56.210 is applied to the cases when the shares are issued to any investor. Now there is one more conflict. In fact, I was having one question in mind. Just a minute. Okay, probably I forgot it. Yeah, actually, in fact, there are some tax experts over here. So I have one question in my mind, if anybody can solve this doubt. Is it mentioned somewhere that 56.2(7)(b) is not applicable in case of a right issue? Like 56.2(7)(b) is saying if company is issuing shares, which is unlisted company, then the issue price should not be more than fair market value. So is this provision equally applicable in case of issue of right shares? So that's my question. So my mobile number I have already shared. Okay, no if listed company issue right share. Fantastic. Okay, I would like to know about unlisted company also. I would like with the section, subsection, clause, subclause, or any decision of any tribunal or court if it is there. Okay, Anupji is saying it is not applicable. So if anybody can share at my number the rationale why it is not applicable, which sentence or which word you are interpreting that it is not applicable, I would like to learn it. I need your help for this. Asha ji is saying, so issue share at fair market value to avoid tax. See, this conflict is unavoidable because both fair market values are calculated as per the Income Tax Act and two different provisions are there. This conflict too, Asha ji, probably what you answered suits better to this conflict number 2. Say my company is issuing shares on preferential basis. If valuation given by the registered valuer under company is at is rupees 500 per share, then the company's rule says that, oh, I'm not audible.
You are audible, sir.
Am I
no,
audible? Okay. Tanmay ji, please check at your end. Somebody post a private message to Tanmay ji that please he checks at his end. If valuation is given by registered valuer under Companies Act is rupees 500 per share, and as per Companies Act, company cannot issue shares at a price below the fair value. And valuation in the same case, now I'll have to engage the merchant banker also. See, if the company is issuing equity share, two valuers will have to be engaged. One registered valuer as per the Income Tax Act, and one merchant banker as per the company. I just swiped it. One registered valuer as per Companies Act and one merchant banker as per Income Tax Act. Now suppose merchant banker gives a valuation of 400 rupees. Now there is a conflict. If I issue shares at 400 rupees, I am in non-compliance of the Companies Act, which says that you cannot issue shares at a price below fair value. But if I issue shares at 500 rupees, I'll be caught under 56.2(7)(b), which says that fair market value is 400, you are issuing at 500, so 100 rupees is taxable in your hand. This is the problem. There is one practical solution to this problem, that the merchant banker and the registered valuer, they should work together. Practically it's feasible that you appoint people and say them, guys, coordinate yourself and coordinate and arrive at a consensus value so that I am in compliance of both provisions. So yes, this conflict can be resolved practically. Theoretically there may be a dispute, but practically it can be resolved. But this one, I'm not sure how to resolve this. Now, the next one is valuation under FEMA. So I can broadly classify it into 3 parts. If you have any questions, keep asking it. Don't wait for the end of the session to ask the question. Keep asking it. Foreign direct investment. We are talking about FDI. We are not talking about FPI and anything else. Issue of shares by unlisted Indian company. If it is done, it must be done at or above the fair market value. You know what Companies Act says? Issue shares at a price which is fair value or above that. What FEMA says? Issue shares at a price which is fair value or above that. What Income Tax Act says? Issue shares at a price which is fair value or below that. So if you want to avoid the conflict between FEMA, Companies Act and Income Tax Act, you should issue share exactly dot at the fair value. Company can issue at or above fair value so that unnecessarily money cannot flow out of India. 10 rupees worth of share you are issuing for 1000 rupees. This is you are transferring your black money from India to other country. Not allowed. You cannot issue above the fair value. Who will decide the fair value? Merchant banker, CA, CMA. Here you have great scope. And for this only, you will have to learn valuation. You must learn valuation for this. Transfer of share of unlisted company from resident to non-resident. Same rule is applicable. I did one such valuation in the capacity of a chartered accountant, and we decided one value, and then those shares were transferred from resident to non-resident at that price or above that price you can transfer. Again, the purpose is money should not flow out of India unnecessarily. If non-resident in transferring shares to resident, in that case, transfer should be done either at fair value or below fair value. So if money is to be paid by resident to non-resident, non-resident transferring share, so Indian person should pay either the fair price or lower than the fair price. He should not pay more. So this should be certified again by CA or merchant banker or CMA. See. So now I'm covering the first point. In the first point, FDI issue of share by listed company and then by unlisted company. By listed company, how do you calculate the fair market value? Fair market value is the price as per the SEBI ICDR rules. Issue of capital and disclosure rules. Who will certify it? You know, report is not required, but certification is required. Certification by merchant banker or practicing chartered accountant. You know, FEMA even does not say practicing chartered accountant. It is our code of conduct which says you should be practicing if you want to sign it. They simply say, I guess, if I'm not wrong, they simply say chartered accountant, not chartered accountant in practice. But definitely he must be or she must be in practice. Now, what SEBI ICDR says? Higher of the average of the weekly, high and low of the volume weighted average price of last 26 weeks and last 2 weeks. Just like the infrequently traded shares of listed company, same formula. Here you don't need report. Here you just need certification that this is the fact, I certify it. But if it is unlisted company, the valuation must be done as per internationally accepted pricing methods. So IVSC issued international valuation standards should be used. And here, not only the certification, but actually valuation report is required by merchant banker or chartered accountant. And definitely issue price should be equal to or more than the calculated price. This is issue of share. In case of transfer of share from resident to non-resident, so Indian person is transferring to the foreign person, transfer at or above fair value, valuation should be internationally accepted pricing method. So for that, one has to read IVSC, International Valuation Standard Committee's valuation standards, a series of valuations. Just like accounting standards, we have valuation standards also. So you need to go through those valuation standards. And then only you should certify the deal. Valuation and certification required by merchant banker and chartered accountant. But if it is transfer from non-resident to resident, same. Only thing is it is at or above, this is at or below. Internationally accepted pricing method, valuation certified by merchant banker or chartered accountant. If it is transfer of share from non-resident to non-resident, then other formalities are okay, but pricing norms are not applicable. they can transfer at whatever price they wish. There is no requirement from the side of FEMA. What about CCPS or CCD under FEMA? Conversion price or conversion formula to be fixed upfront. So Asha ji, if you're there, you were asking at the beginning, you were right. Because under FEMA, if you're issuing compulsorily convertible preference share and debenture, conversion price or conversion formula, either the conversion price or the conversion formula, one of the two, should be fixed up front. Conversion price under conversion formula should be in compliance with pricing guidelines. So if I say that one preference share will be converted into 2 equity shares, and if one equity share is currently worth 70 rupees, one preference share will be converted into 2 equity share. I have fixed this after 5 years. And currently one equity share is worth rupees 70. So now this one convertible preference share should be issued either at 140 rupees or above that price. So conversion price must be more than the current fair value. Now Asha ji, as you were asking, can we have a variable conversion ratio under FEMA? Yes, it is allowed. It's not necessary that you fix that one will be converted into 1 or 1 will be converted into 2 or 2 will be converted into 1. No, you can even have a variable conversion ratio. But in that case, conversion price at the lower end of the price spectrum, that is the maximum number of shares to be allotted, must be more than the current fair value. So some variable formula is there. Still, you will have to decide that for one preference share, maximum 10 equity shares will be given. At least you will have to give a cap. And now suppose one equity share has a fair value of 50 rupees. Yes, Amit ji is asking, can we have a future event-based conversion ratio, say a performance-based factor? Yes, Amit ji, that can be there. But keep in mind, you will have to decide a cap also. If you say, if you say we will decide that day based on performance, then you will have to decide a cap that one preference share will be converted into maximum 10 shares. Even if the fair value of equity share on that day is very low, but you will not get more than 10 shares. This you will have to, yes, it is variable, but decide a cap. So maximum 10 shares you are giving. And currently one share is having fair value of 50 rupees. So 50 rupees multiplied by maximum 10 shares you will give. Current issue price should be equal to or more than 500 rupees. Current issue price should be equal to or more than 500 rupees if the maximum shares you are ready to give are 10, because the conversion formula is variable based on future performance. So decide a cap at least. There is no floor. Minimum we will give half share, 1 share, 2 shares. There is no limit for minimum. But you need to decide a cap. And once you decide the cap, say 10 shares and 1 share has a current fair value of 50. After 5 years, what will happen? I don't know. So 10 into 50, 500. So this CCPS should be issued at a minimum price of 500 rupees. And again, the valuation need to be done by chartered accountant or SEBI registered merchant banker. Now the last one is valuation under IBC. So I will quickly go through it. Once the company goes into insolvency professional is appointed. And I said he will appoint 2 valuers of securities, 2 valuers of land and building if there are any, 2 valuers of plant and machinery if there are any. So total 6 valuers are being appointed. And a huge scope of valuation is there, but I personally prefer IBC cases for valuation. I don't prefer it. If it is lucrative enough, then only I indulge into it. Number one, the fees payment is always delayed, because if the company IP is not able to sell the company, then the company will go into liquidation, which may take several months thereafter. And on liquidation, then you'll get your fees. Number one, the fees is actually delayed in IBC cases. And number two, actually the scope of SFA people is less, because mostly the unit is sick. So I'm not saying always, but cases, in many cases. So ultimately, eventually the role of land and building valuer and plant and machinery valuer increases, and the valuation as a security valuer, the scope actually is on the lower side. They don't pay very handsome fees, and the fees is paid in delay, and lots of disputes are there between the committee of creditors and the management of the company, and the NCLT case will be there, and you're answerable to anybody, and lots of things. Okay, two questions are there. If non-resident director in Indian company transfer all his share to other Indian director, see, the non-resident director is transferring share to resident director. Valuation is very much required, and the transfer price should be either at the valued price or below that price. And the same was transferred to NID director again. Is the expense to be borne by the company? Now the question is, who will bear the valuation fees? Because it is transfer of share, not issue of share. So actually company do all this formality because company does not want to look in non-compliance of FEMA. So when I did this valuation, I took 2 appointment letters. One appointment letter from company and the other appointment letter from the Indian person who was transferred in my case. So because, who will make available records to me? Shareholders cannot, because he was not director. So it's better to take appointment letter from both of them so that you remain safe. In fees, in this case, unlisted company, in this case, either it can come from the company or from the director, that is the shareholder, or partially from both. Amit is saying in FEMA, if we are issuing securities at face value with a conversion formula, then when to conduct the valuation? Sorry, you might have mentioned this. No, Amit, you cannot issue at face value. Suppose you are issuing a variable, you're asking conversion formula. So your conversion formula is variable. So you cannot issue at par. First of all, decide the upper limit of number of shares under the conversion formula. And as I mentioned, suppose one preference share is 10 equity share. That is the maximum limit. And now calculate current fair value of equity share, which is 50 rupees. So even if the preference share has a par value of 100, you will have to issue it at least 500 rupees. You cannot issue it at par. You will have to issue it. The conversion price should be equal to or more than the fair value of that instrument. And then you will again need a valuation when converting, because at that time you need to calculate a fair value to decide. So if fixed formula is there, you just need one valuation report at the time of issue. If variable conversion formula is there, 2 times valuation will be required by the chartered accountant. One at the time of issue of security, second at the time of conversion of security. Right, sir? So valuation under IBC is a huge scope. I personally prefer it less. Yeah, I do it. But if the good case is there, if volume is there, if my scope is there, if just thappification is there, I don't prefer it. Under SEBI guidelines, in some of the SEBI guidelines, right, real estate investment trust, infrastructure investment trust, and issue of securitized assets and infrequent dated share. Only these SEBI guidelines specify that you need a registered valuer. In all other situations, price is usually certified by a chartered accountant. So with this, I would like to say a big thank you to all of you for being here for a 3 hours period of time, which is actually a long time, non-stop, without any break. And you stayed here, you participated, you asked questions, you took interest. That's a sign of a growing profession where you are ready to learn every day with all your regular commitments. And my sincere thanks to the committee of the Indore branch that during the pandemic, these guys have done a fantastic job, the entire team. I must appreciate them. My contact details are there. If any of the questions remain unanswered, you can ask me later. Rather than calling, if you simply drop WhatsApp, that will be the best way of communicating, and save my number also, so that later, if anything is there, if I broadcast anything to you, then at least you will be able to receive it from my end. And most welcome, Pankaj Rathi sir, and Supriya ji, Harish Damija sir, Ravi Chona sir, saying very, very nice session. Thank you. Vidya ji, freshly qualified member seeking a career in valuation, kindly brief on that. Valuation of capital instrument done as per the how to select methodology. How to select methodology, Vijay sir, maybe in the next session we will learn how to select the method. All right, so now over to the team, Indore.
Thank you, sir, for your wonderful presentation. After 3 hours marathon like class, it's like अभी basic understanding सबको एक बार की हो गई है. Later on we will organize another program to go into depth how we can practically do the valuation and how it will go further. Thank you for giving all of us the knowledge about the basics and overall picture of valuation, like under Companies Act, IBC, FEMA, income tax, and other laws. Thank you for such a great words and great speech.